Everyone, good afternoon, good evening to all of you. आज है 19th of May 2025. वेलकम वंस अगेन टू दिस लाइव एनालिसिस। स्टार्ट करते हैं आज का ये सेशन। फिलहाल के लिए अगर देखोगे क्रूड ऑयल को तो एक फ्लैट कह सकते हैं ओपनिंग हुई थी, गैप डाउन हल्का सा, देन सेल ऑफ आया एंड नीचे एक छोटा सा सपोर्ट था, वहाँ से पुल बैक आ रहा है। आई एम एक्सपेक्टिंग दिस रेंज नाउ, ये बीच का लेवल अब होल्ड होना तो नहीं चाहिए। यहाँ से एक वापस सेलिंग का प्लान करेंगे अगर ओपन इक्वल टू हाई नहीं बनती है तो। बाकी क्रूड ऑयल में देखो दो चीज़ हो सकती है, अगर ये डायरेक्टली आता है नीचे तो यहाँ एक बाइंग, पुल बैक देता है तो यहाँ एक सेल। काफ़ी ट्राई किया बायर ने लेकिन होल्ड नहीं कर पाए लेवल को, सो देयर इज़ अ वेरी हाई प्रोबेबिलिटी कि प्राइस को अब नीचे ही आना चाहिए। इन लोगों ने लाइक नहीं किया, डोंट फॉरगेट टू लाइक द स्ट्रीम एंड सब्सक्राइब द चैनल एज वेल। लाइक भी करते रहो गाइस, जिन लोगों ने लाइक नहीं किया, डोंट फॉरगेट टू लाइक द स्ट्रीम।
Here was it was an overly aggressive, overly truculent, erroneous approach from which there has been a significant but still not total retreat.
Larry, take a step back from the particulars of balance of trade and fairness in trade. As a macroeconomist, we do have the second largest economy in the world, by most measures, by some even the largest economy in the world, that is not market driven fundamentally. It is centrally planned, and they've built up a huge productive capacity. How does one deal with that? I don't think we've ever had to do that in the past. How do you deal with that in terms of trade terms and making sure that it doesn't distort things in our country?
Well, I think what you do is you focus on your own economic interests. And if others want to subsidize your consumers, if others want to subsidize your producers, that can very easily be a good thing. And so you try to define what your core interests are. We have a core interest in national security, and in everything that's national security sensitive, we need to be trying to pivot away from China. We need to be very attentive to the security risks of Chinese presence in the United States. That's issues like TikTok. We need to be very focused on preventing China from getting access to intellectual property in ways that's going to enable them to surpass us. But you have to focus on your core interests. And when you're worried about the export of Barbie dolls, you're not focusing on your core interests. When you're worried about trying to get jobs here, putting together the different components of an iPhone, you're not worried about your core interests. So yeah, we do need a strategy with respect to China, a strategy directed at getting them to follow rules of the road where that's important for our core national security interests. But this kind of broad, indiscriminate attack that has been launched that mostly serves to cause Americans to feel poorer, mostly serves to increase our inflation, That's not the right way forward. So I'm glad to see the adjustments that the Trump administration has entered into.
The tentative agreement reached in Geneva was just that, tentative, leaving a lot of work to be done before the United States and China can reach a long-term solution to their trade conflicts. Elizabeth Economy is a China expert at the Hoover Institution who keeps careful track of the relative strengths and weaknesses of the world's two largest economies.
I think both countries have economic vulnerabilities. I think the assessment on the part of the Trump administration was that China was more vulnerable because it exports much more to the United States than the US does to China. Its economy has also been struggling. It's been in a prolonged economic slowdown for at least 3 years now. But I think there was a fundamental miscalculation on the part of the administration. They didn't appreciate that we have a much greater sort of sole or near sole source reliance on a number of critical products from China. Critical minerals, rare earth elements, active pharmaceutical ingredients. These are all things that are essential for our economic security, our national security, our human security, and will devastate, quite frankly, our pharmaceutical industries and our defense and technology industries. So there's a balance, I think, between the Chinese vulnerabilities and the US vulnerabilities. Both of us, I think, have serious vulnerabilities in the space of this tariff war.
Does the rest of the world give one side, between the United States and China, an advantage over the other? I mean, both sides historically have tried to recruit the rest of the world.
I think for the advanced market democracies, what we've seen has been, in some respects, somewhat surprising. I think there was a belief on the part of the Chinese government that given this tariff war, this global tariff war that President Trump has launched, that it would be easy pickings, that China would walk in and basically say, we are a stabilizing force in the global economy, we're a stabilizing force in the international system. And they've gone around saying, let's join hands and work together to push back against President Trump and this tariff war. I think what they found is that really nobody's that interested in buying what they're selling. There's an entire world now emerging that is set to support the current rules-based order that doesn't include the United States, but also doesn't include China.
One destination of Chinese goods that otherwise might be exported would be domestically, increased domestic consumption, which has been talked about for years now. What are the prospects? In fact, Xi Jinping might say, okay, we're going to stimulate the consumer.
I mean, Chinese economists have been saying for years now that the government needs to do more to support the consumer economy. And part of that would be, investing more in the healthcare system, the education system, the pension system, giving the Chinese people a sense that they don't need to continue to save in the case of an emergency. But Xi Jinping is allergic to what he calls social welfareism. He doesn't want to give the Chinese people any incentive not to work. At least that's how he looks at it. So again, we've seen President Xi over the course of this tariff war take a few steps, in the form of raising wages for civil servants, notwithstanding the fact that a year ago or a year and a half ago, he actually cut those same wages. So I don't know whether this is an actual increase or it's just taking them back to where they were. And also, again, having this massive goods trade-in program. But mostly what he's done, I think, is encourage banks to loan to small and medium-sized enterprises. You've seen Alibaba, for example, reduce the cost of companies putting their goods on its platform to encourage small and medium-sized enterprises to be able to export. So there are steps that are being taken, but there's nothing in the way of sort of a massive boost to the consumer economy that I think Chinese economists would like to see.
Coming next, the story of NASDAQ in Europe and how Sweden's deep and robust capital markets connection to tech startups could give the rest of Europe an example to follow.
5, 4, 3, 2, 1, 0.
This is a story about attracting bees with honey, specifically the honey of rich capital markets attracting the bees of tech entrepreneurs, something that has helped drive U.S. economic growth, but that has largely been lacking in Europe, except in one particular corner.
About 39% of household assets in the United States are invested in equities, which is the highest in the world. But here in Sweden, it's 36%.
And it's not just how much, it's how broad.
About 90% of the Swedes' savings are in some financial asset, which makes us the most investing country, at least in Europe.
We're blessed to have a broad equity participation, so lots of people who own stocks directly. What that does is, of course, it creates this economic alignment, etc.
We've come to expect robust capital markets supported by retail investment in the United States, but not necessarily in Sweden, a Nordic country with a population of just a little more than 10 million people that punches above its weight in the depth of its capital markets and is home to NASDAQ's European headquarters.
We operate our markets here and also in the Nordics. We own and operate almost all the markets in the Nordics.
We spoke to NASDAQ CEO Adena Friedman in New York in April, not long after President Trump had roiled the markets with his sweeping tariff announcements.
So on options in 2024, we had an average of about 24 million contracts traded a day. On Friday, we had 94 million contracts traded. Now, what generates that, though, what's really, really interesting is options markets are extremely data heavy.
Friedman and her NASDAQ team have plenty to handle with U.S. markets, but they also run European operations almost as large in what they call NASDAQ Nordic, which became part of the group in 2008. We accompanied Friedman on a trip to their European headquarters in Stockholm.
Well, Stockholm is one of the great markets that we own and operate here in the Nordics, but it also is the headquarters to our market technology business, where we serve 130 markets with our technology that helps them power all those markets around the world as well.
How much of NASDAQ's overall operation is represented in Stockholm?
Well, we have about 800 employees here in Stockholm, slightly smaller than New York, where we have about 1,000 employees in our New York office. So it kind of gives you a sense that this really is our second headquarters in the world. It's one of the special places that I get the benefit of being able to come to as we engage with the markets here in Sweden. One of the things that I find interesting is how similar it is here in Sweden versus New York. So the markets in Sweden have a lot of characteristics to the markets in the U.S., which is different than the rest of Europe. So when we look at it, we look at, well, how liquid are the markets? How many new companies come and list here in any given year? How active are the markets in terms of having retail ownership of equities? And in many, many cases, those are very similar to the U.S. So we have 1,200 companies that are listed in the Nordics. And in any given year, we'll have dozens of companies list here, both small companies on our SME market, which is called First North, and on the main market. So we're really, really proud of the fact that the markets here are very vibrant and have a lot of similarities to what we see in the U.S., but sitting here in Europe.
One sign of its strong capital markets is Sweden's IPO pace. Between 2013 and 2024, there were more IPOs in Sweden than in Italy, France, or Germany, second in Europe only to the UK.
The U.S. markets are the largest, deepest, most liquid markets in the world. But when you look at that, how that's translated into the markets here in the Nordics, it actually has a lot of the commonalities. The market cap of the listed companies here in the Nordics are about $2 trillion versus, of course, we have about $30 trillion in the United States just on NASDAQ. However, the liquidity that underpins that market cap here in the Nordics is quite vibrant, very active.
We have lots of IPOs in Sweden. We have more IPOs than many European countries together. And I would say that is one important source.
Sweden's vibrant IPO market is no accident. It results in part from government policies that encourage household participation in the markets, starting with taxes. Niklas Wickman is Sweden's Minister for Financial Markets.
First of all, for the smallest entrepreneurs and new entrepreneurs, closely held corporations, as they are called, they have strong tax incentives because there's a 20% tax on dividends within a rate of return allowed. It's quite complicated, but it's also quite strong incentives to do business. And then we have the ISK system that takes down the cost of capital, so to say, or it provides at least more capital into the system because you have a low effective taxation on your invested savings. So I would say those are two important aspects, one for the entrepreneurs and one for the providers of capital. We have strong incentives to stay in business for a long period of time. We don't have any inheritance tax, we don't have gift tax, we don't have tax on accumulated wealth, or wealth tax, as you normally say. So I would say there's strong incentives to provide capital in the system. There are strong incentives to do something good with it, and it's strong incentives for active owners to remain active and perhaps to involve their families and keep their businesses over generations.
Another big driver of retail participation is an investment account known as an ISK, a government program under which 2.5% of every employee's wages are put into an account in their name, which they can allocate among a range of funds. These funds are not subject to capital gains tax. Instead, they are taxed 1% each year on the value in the account.
One of the great examples of where regulation has played a really key role in driving liquidity in the markets has been that ISK program, where they started in 2012 and they said every citizen should be investing in the markets. So therefore they said, okay, well, we'll create a tax account where you're only taxed about 1% of your total assets every year. No cap gains tax. So it means that investors can really bring their money into the markets. Their only obligation is to invest in the public markets anywhere. And it allows investors to have a great engagement with the economy.
Christian Cederholm is the CEO of Investor AB, a company which serves as the investment arm of the Wallenberg family, one of the most prominent families in the country. In the 1970s, Wallenberg family businesses employed 40% of Sweden's industrial workforce and accounted for 40% of the total worth of the Stockholm stock market.
This has created this sort of positive flywheel effect where owning stocks in a company, you may even work for that same company, by the way, and we're blessed to have a great number of, even just going in looking in Sweden, great number of high quality companies. So you may work for them, you may be invested in them, and of course that creates this engagement around business as part of a society.
You mentioned the breadth of ownership of equities in Sweden. As I understand it, there are 10 million people roughly in Sweden. You have 650,000 shareholders yourself at Investor AB. How do you explain that breadth? How does that happen?
Well, I mean, first of all, we're really thankful for the trust that people put in our work. And you know that they appreciate what we're doing, so we're quite humble to that. The way I look at investor, what you get is you get engaged ownership and active investment in a portfolio of about 25 really good companies, so high quality companies, and at a relatively slim cost as well. And then, of course, over time, it helps that we have created a strong total shareholder return over most sort of longer time periods, at least. So something seems to be working with the model.
And I think it serves two purposes. First of all, it's about social coherence. You have your job, you have your salary, but you also have a share of the most productive part of the economy that belongs to you because of your savings. And it's about, then, of course, economic efficiency. It provides capital for inventors and entrepreneurs. So it's, I would say, both about social coherence and economic efficiency in a very nice combination. Our social security system is important. It makes it possible to take risk, both with your savings, of course, but also in your work life as a whole. When you have some basic, trustworthy welfare system, you know that you can have a bit more risk, of course, in the rest of the economy. So I think that is one important topic. But of course, also the culture doesn't come from one source. The welfare system could be one such source. The education system could be another. And also, of course, that we provide financial stability, that we safeguard our financial system.
What does all this mean for Sweden's economy as a whole? Its GDP is projected to grow 2.3% in 2025 compared to just 1.7% for the United States. Perhaps as important, is Sweden's level of productivity, which drives future growth.
Recent years we have had the same problem as most of the Western world, or especially the Europe as large. We have a productivity problem, but if you extend the time period a bit, you can see that Sweden is exceptionally productive.
Sweden's approach to encouraging broad and deep capital markets comes in sharp contrast to some of the rest of Europe. In his report on European competitiveness, former ECB President Mario Draghi pointed to the lack of sufficient capital support as one reason why Europe has lagged behind the United States in the growth of tech giants. Henry McVeigh is the head of the Global Macro and Asset Allocation Team at KKR, and we spoke to him after he returned from a trip to Europe.
When you look at it as a percentage of GDP, it's about a third of the U.S. And so there's clearly been a differential over the last 10 and 20 years. That's on the equity side. On the credit side, what I think Europe has missed is it's really been so bank controlled that you've missed the real growth in the securitization market. So if you think about the U.S., we securitize everything. It goes into the capital markets.
The Draghi report talked about that. Will that shift capital markets, do you think, in Europe?
Well, it's certainly been a big wake-up call, first of all. And if I take my positive hat on, what I say is that hopefully now what you can read in the Draghi report, etc., is turned into real and concrete actions as well, so that Europe can leverage all the advantages it has. I mean, it's a large market, stable institutions, whatnot, so and high equity participation in some parts of Europe as well. And then whether it shifts, I mean, it seems to, just looking at where valuations have gone recently, some of the shift you describe seem to, be in the making. Where that goes long term, probably others are better positioned to tell, right?
If capital markets are key to innovation in tech, what has the Swedish approach to retail equity investing meant for its startup record? That's where we turn next, after a short break for coffee and fika, the pastry that Swedes enjoy during their workday afternoons.
We're in Sweden, so we have to be having
coffee.
coffee.
We have to have fika.
Right.
So, fika means cake. So you get,
it does?
Yes, fika is cake with coffee.
Oh, I see.
So yes, exactly. So we're going to have a fika later
and this
today.
This is a tradition, right?
It is. Actually, every Wednesday, normally, we have a fika celebration where we just get everyone together. So the whole purpose is not to talk about work, is to talk about each other and to create that sense of community. So I love it, but it's a huge tradition here, and now we've brought it everywhere. You don't toast in Sweden. Do you want to learn how to toast? Well, you toast, you say skål, but you don't clink.
You don't clink. Oh, that's
you look at each other in the eye, you drink, and you look at each other again. It's an old Viking tradition. Like, the idea was that if I'd poisoned you, I wouldn't be able to look you in the eye.
The Draghi report on the future of European competitiveness called for Europe to develop a deeper pool of angel investors and increase European IPOs to fund high-growth companies. So has Sweden's commitment to these sources of capital resulted in a more robust startup culture? Sweden has produced more tech unicorns per capita than any other country in Europe after Estonia. And according to the World Intellectual Property Organization, Sweden ranks second in global innovation among 51 high-income countries, second to Switzerland, and just ahead of the United States.
Sweden has some well-known brands going to like IKEA, H&M, Ericsson, or more recently Spotify and Klarna. So it's a strong culture of entrepreneurship, which has fostered, in a way, innovation, of course, but also investments in the community at large, and sort of from a capital market perspective. So in Stockholm in particular, I think it's a small city, but investors are never far away.
Ali Lundin is the CEO and one of the co-founders of Froda, a tech startup that provides small and medium-sized enterprises with access to financing.
We started the company back in 2015. We came across the idea when we were sitting at Stockholm School of Economics, have an incubator called Stockholm School of Economics Business Lab. And we realized at the point in time that all these entrepreneurs who were sitting at that incubator starting their businesses were struggling to get access to external financing. And we realized that this is a huge problem and it's really hampering innovation and growth and competitiveness all across Europe.
Even Sweden's retail banks work to bring their customers into the world of investing.
One of our things to do is to help people to educate them in financial literacy. So that means that in the old days, the savings banks gave like a few kronor to when you were newborn and you could save it. And what we do is we talk with youngsters, we educate them on financial literacy, we give them easy ways to invest in equities, to put their money into pensions and things like that. So we help people through that journey to make sure that in the end they have good financial health.
Jens Henriksson is the CEO of Swedbank, one of the largest Nordic banks, with around 75% of its revenue coming from Sweden.
We're a nation of engineers, and we're a small and open economy. And sometimes people ask, are you not afraid that the new technology will sort of make you lose your job? And people say, no, we're afraid of the old technology because the old technology might hurt, might sort of make us weaker. We need new technology, develop going forward, increase growth and make Sweden welfare and a better society to live in.
Sweden's support for innovation goes back decades.
I remember back in the early or mid-90s, there was sort of an initiative called Bring a Computer into Every Home, which was launched by the government and essentially meant that each and every household in Sweden could get a computer for almost no money at all. I think what we don't have to the same extent as, for instance, the US, you have the pockets of Silicon Valley, those huge funds that can invest billions and billions of dollars. We don't have that. So I think what that means is Swedish tech companies or startups need to show profits earlier in their journey compared to their US counterparts. Also, it's kind of a small market. You need to demonstrate scalability. You need to be able to show that this is an idea that's not only sustainable in this tiny sort of Nordic market, but this is an idea that you can actually export across the globe. So there's a requirement that you need to be able to show how this works across the globe, or at least in a lot larger market, not only Sweden.
Sweden's innovation ecosystem is supported by more than its tech or tax and savings policies. Today, the country's social welfare policies also have expanded to support the risk-taking needed to foster entrepreneurship.
It is a very vibrant innovation ecosystem. I think that the government has done a lot of work intentionally to make sure that they allow companies to take risk, allow companies to grow and expand, become global players. And then they have a great system that also encourages citizens to invest in these innovators.
Our social security system is important. It makes it possible to take risk, both with your savings, of course, but also in your work life as a whole. When you have some basic trustworthy welfare system, you know that you can have a bit more risk, of course, in the rest of the economy. So I think that is one important topic. But of course also the culture doesn't come from one source. The welfare system could be one such source. The education system could be another. And also, of course, that we provide financial stability, that we safeguard our financial system, make it in the long term high functioning, well functioning.
We don't do a lot of, call it early venture capital, startup investment ourselves. But if I look at innovation more broadly, then I think one part of that is maybe our small home market, right? Meaning that we've always been forced to go out there and compete with the best in a way. So that's one big driver. Then I also think that we have some more societal infrastructure that works for us. Just to mention a few, I mean, one is free and generally high quality education for all, which is broadly available. We also have pretty generous welfare systems, including childcare, which has helped, of course, to create labor market participation.
Access to capital through private markets is an important part of the innovation puzzle.
Europe actually has about the same number of venture capital companies per year that gets hatched, which is interesting relative to the U.S. What Europe has been missing is those global dominant firms, $100 billion and more. Typically, those companies are actually getting bought by U.S. firms. So there is the beginning of the food chain on innovation, right? Entrepreneur is actually a French term. But what's happening is you haven't made it to create a global dominant giant. You have ASML, but you don't have the type of companies that you have with Google and Meta and Microsoft. And so that, to me, is the opportunity set, is to really see that value chain all the way through. You haven't had the same opportunity set. In the US, it's maybe 25% of the index, and in Europe, it's 7%. So there is entrepreneurs and there's growth, but a lot in the public markets, a lot of that's been concentrated in the US markets.
Investor AB is one of the most important sources of private capital for Swedish companies, but its take on private equity looks different from the United States.
Basically, when we make an investment, we do it not having exit as part of the strategy. And that means that we're really picky about getting companies who are in industries or end markets or niches where you have some kind of structural growth tailwind. We don't love to sort of fight gravity, so we prefer the tailwind. And then companies with a long-term right to win in those markets. And typically, and it goes back to the point about innovation, if we look at our companies across, call it 25 or so companies, most of them have leading market positions, and they have that thanks to leading or sort of best-in-class products and this obsession about the products and the customers. So that's, I think, we're really picky on that, the long-term attractiveness of both the company but also the industry that they're in, because we're wary that it's better basically with some tailwind and some headwind. To be clear, we have shareholders in all parts of the world. We have Nordic roots, but we see ourselves as global investors. And if you look at our companies, they typically have the Nordic roots and the Nordic heritage, but coming back to our small home market, etc., they're typically active across the globe. If I look at Investor AB and the company as such, we have operations here in Stockholm and in New York. So those are our two sort of home markets. And that's where we go look for new platform investments or new logos, if you want.
Sweden's model has worked to jumpstart its innovation and growth, but replicating it in other parts of the EU is not as easy as it sounds.
There is a huge interest from other European countries and from the European Union about the Swedish case. How did we succeed to have our households to have this large retail participation in the financial markets? How did we succeed in reforming our pension system? How did we succeed in getting those tax incentivized saving products in place that provides the households with a better return than they would have in just a system where you pay taxes and get benefits from the government, and then of course also provides corporations with more capital than in other countries. So there is a huge interest in the Swedish example. And since we're humble people, of course, we always say that, well, it's a matter of several factors. It's not one thing you could do here.
If Europe manages to adopt the Swedish model of supporting capitalism with social welfare, the growth upside of the EU is high, but Sweden is setting its sights even higher.
We say that the United States needs to watch out if we manage for the whole of Europe to do this, because then we will be a much more efficient competitor.
And that means that you have free education, you have free universities, you have daycare, childcare, you have, and you can continue with all these things. And then people can take a bit more financial risk. And you're right, it is risky in that sense. But we know that risk usually pays off in the long run. Well, at least history has shown us that.
Coming up, we talk with the new Secretary of the Army, Dan Driscoll, about the transformation plan he presented to Congress last week and how it would address some of the issues at the Pentagon we reported on last fall. This is an update of a story we reported on last November about getting our money's worth in our national defense spending. Last week, the new Secretary of the Army presented to Congress his plan to transform the largest branch of the U.S. military.
The system is broken, but nobody felt like they had the power to change it.
Dan Driscoll is the Secretary of the Army serving in Trump's current administration, which plans to redirect 8% or $50 billion of non-lethal Defense Department spending to innovative weaponry.
With President Trump's leadership and his kind of incredibly high risk tolerance, we were empowered and given the top cover to basically go fix the things that are broken. And so fundamentally what Army Transformation Initiative, what we call ATI, is it does four things. So the first bucket of things that it does is it looks at our obsolete equipment and processes and the things that have led to bad outcomes, and we stop buying those things. And so some examples of that are Humvees. We have Gray Eagles, which are big, large drones that have been around for decades, and they just don't fit on the modern battlefield. And a robotic combat vehicle, an RCV, it's an exquisite $3 million piece of equipment that can be taken out by an $800 drone. The math just doesn't work. Bucket two is what has led to the types of contracts that have gotten us into these outcomes that we don't want. So in some instances, we have given away our right to repair our own equipment. We would see this exquisite equipment sitting on the sidelines for 8 or 12 months at a time, and our soldiers could 3D print the $2 to $20 part to get it back in the game. Bucket three is essentially taking the savings from cutting the obsolete equipment and recycling it to the things we know we need. Modern warfare is going to be a mixture of autonomous vehicles and drones and data. It's buying all of that equipment and really just giving us a command and control layer for the modern battlefield. And then bucket four is the bloat. We have just too many people up in our leadership. And so we're going to do things like cut 1,000 people from the Pentagon. We're going to push those soldiers that are stuck up here pushing paperwork around. We're going to get them back in helmets, get them back in formations to do the jobs that they actually signed up wanting to do.
Those who know have been calling for changes like these for a long time. Former U.S. Deputy Secretary of Defense John Hamre says the Pentagon's failure to adapt compromises its ability to fight.
We are not well organized for sustained long-term conflict. It would really be a strain for us to manage a 3-year war. We tend to buy too few weapons for long-term warfare. Our industrial base is sluggish. It's not that the companies aren't willing to produce, but the government isn't willing to give them resources for surge capacity. We could fight a terrific short-term war, but if we had a prolonged war, it would be a challenge.
I think there are two problems. One is that we're not spending enough, and two is that we're not spending wisely enough.
Amy Ziegart is a senior fellow at the Hoover Institution.
Our overall defense budget has a yawning gap with the capabilities that this nation needs to advance national interests. At the same time, we need to be spending money on low-cost, high-tech, affordable, unmanned systems and other capabilities. There's been a lot of discussion about doing that in the Pentagon, a lot of discussion about doing that in Congress, but those kinds of systems are still rounding dust in the Pentagon budget compared to where we need to be. This is the most dangerous and the most complicated threat landscape the United States has faced since 1945. We have great power competition with China and Russia, and then there's Iran and North Korea. And we also have non-state actors. Terrorist threat levels are increasing again, and they're enabled by new technologies, which are spreading rapidly. It's a very demanding landscape. The United States Defense Department is having to do more, and our budgets have not kept pace with the threat landscape. So as a percentage of GDP, the U.S. government is spending half as much today on defense as we did in the 1980s. We're spending 1/20th as much on defense as we did in the Korean War. So the needs are growing, the funding is declining.
If you look at the Pentagon for the last 30 or 40 years, You've had this very inefficient bureaucratic system that has calcified, and we like to talk about it as kind of like a pretzel for decision-making contorting in on itself.
We've done things inside the Defense Department for many years, but this revolution that's taking place in digital technology is in the private sector. And we don't know how to bring that into the government because we want them to slow down and fit our model. Well, they're not going to do that. Defense acquisition runs at X and the private sector is moving at 5X. I think the greatest challenge going forward is going to be how do we bring in the cutting edge technology the private sector is developing and incorporate it into our weapon systems. And we do not have an answer to that question.
With this new idea of having non-traditional defense contractors and Silicon Valley companies like Palantir and SpaceX that lots of people have heard of, it's bringing new ideas and new innovation, and it's giving us the best of breed technology.
Andy Lowry is the CEO of Epirus, a defense tech contractor that focuses on drone technology, an essential part of fighting the wars of the future. The company is valued at an estimated $1 billion and has raised over $550 million from the private sector.
Epirus makes force fields, just like you see on science fiction movies. We have created the first version of a human-made force field that can protect things like bases, aircraft, tanks, cars, vehicles, stadiums, refineries, borders. All of these things right now are falling prey to an infiltration of drones, not just flying drones. You have drones on the water, drones on land, drones in the air, drones in space. You have cyber-powered drones everywhere. Enter Epirus. Epirus, with our force fields, can now line up right at an edge of a fence and knock everything down like there's a wall of energy that anything that comes into falls to the ground and is rendered useless.
Epirus delivered counter-drone technology to the Navy as recently as March. The goal of their Leonidas system is to take down drones.
These force fields will prevent massive attacks because we can only make dozens of missiles a month as a country. They can make tens of thousands of drones per month, thousands of drones per month. That ratio doesn't work. We'll never keep up. We'll lose to the attrition, the war of attrition, unless we come up with what? Force fields. If we put force fields up, then those drones doesn't matter. 10, 100,000, just rack it up the cash book because every one of those is 10K, 15K, and you're losing them one again, and again. So we actually flip this whole paradigm over on its head and cause them to have to say, now what are we going to do? Do we still want to fight fights with drones and just risk them getting lost to these new systems? We've kind of grown a little comfortable, I would say, in the way that we've been fighting this sort of war of deterrence. But now enter this new age of consumer electronics, highly distributed, highly networked. No one single thing can do that much damage, but when you add hundreds and put them in a swarm configuration, it's the new way that wars are being fought, and it's confounding our Defense Department. And they need help. They need solutions, not from the traditional primes, but from a new age prime, a neo prime, that's able to use the best of Silicon Valley combined with the best of defense in combination to help mitigate and fight and defend against this new emerging threat.
The Silicon Valley's money is also piling into the potential of new defense technology. Defense-related U.S. startups have raised more than $10 billion in venture capital since the start of 2014.
Warfare has changed in the last couple of years. It's an inflection point that humans have been fighting very similarly since probably the dawn of mankind. You didn't have things like autonomous vehicles, you didn't have things like generative AI, you didn't have drone swarms that could be using such cheap equipment. Russia, we think, has manufactured 1 million drones in the last 12 months. That just fundamentally alters how we have to think about these things. And so what we've tried to do is start to include our partners much earlier in the process. We are hopeful that our Army Transformation Initiative will be a renaissance for the defense industrial base, small and medium businesses. We want to get their products in the hands of soldiers as quickly as we possibly can. The larger primes that have been around for a while, they have served a function. They will likely, some of them at least, will continue to serve serve a function for the United States Army, but we can no longer allow them to take 5 or 10 years where we just pay for the innovation that we as a nation need. And so specifically what we are doing is, as an example, we were out on the West Coast with a company that does the autonomous software for a lot of vehicles in the United States, and we asked them, have you done this with any military vehicles? And they said, no, absolutely not. The process is miserable. It takes 2 years. We have to go through all these requirements. We just can't do it as a company. And so we just turned to our team and said, hey, get them a Humvee and get them a infantry squad vehicle in the next week. We got it to them. They said, what do you want us to do? We said, just 10 days. Take it, do whatever you can possibly do to transform our vehicles. They sent us a video 10 days later. They had made our vehicles fully autonomous. 7 weeks later, our soldiers are actually testing that equipment, and we're going to fly in those software developers to come see the outcomes. And so these are the types of things that we have to be doing as an Army. This exists in venture-backed businesses. This is how they do it every single day, and we as an Army just have to get better at it.
Other people have tried to reform the Pentagon. There are a lot of constituents up on Capitol Hill, in the contractors that you work with, even within the Pentagon itself. What has been the reaction of those people who have vested interest in keeping it the way it was?
I think change is hard. I think many of them appreciate that this is necessary. A lot of their sons and daughters and grandsons and granddaughters serve. The Army has its 250th anniversary this year. We're actually older than the United States of America itself. And what's incredibly powerful about that is we touch most Americans in some way, whether it's a coach or a neighbor or a parent. And so I think deep down they know that these are the right changes. I think deep down they know that President Trump and Secretary Hegseth are going to allow us to make these very difficult changes. And so my perception of most of the conversations has been, once they've appreciated that we are not backing down, we are conceding no ground, we are taking zero parochial interests into account, we have set that stage with everyone, Republican and Democrat. We were doing the right thing for soldiers and the American taxpayer, and that is it. I think once they can process that and appreciate this is the actual time where change is happening, we then transition to a mode of, well, what can their business do to thrive and survive in this new model? And we are going to keep testing and learning from our soldiers and closing the innovation loop and executing on the things that are necessary.
Do you understand? Yes,
Coming up, the state of the Chinese economy and its effect on trade negotiations. Every negotiation unfolds against the backdrop of the relative strength of the parties trying to come to terms. We asked Henry McVeigh, head of KKR's Global Macro and Asset Allocation Team, to give us the view from Beijing.
Almost everybody's net worth in China is tied up in the housing market and the stock market, and both were down pretty materially. Housing is actually going from about a 3% drag to about a 1% drag, so it's becoming less bad. Markets react to change on the margin, and we're actually seeing some appreciation of home values in Tier 1 cities. That hasn't been the case since I've been going back to 2020. The areas where they need improvement are really twofold. One is around the middle class. The middle class is not spending the way that they should. They need encouragement. The government is giving subsidies, but subsidies aren't sustainable. So that's an area where I think they ultimately need higher wages. They need more confidence. And then the other thing we've been pushing is really around the, when you think about the migrant population, depending on how you measure it, it's 200 to 300 million. Those people have about half of the propensity to spend as the average Chinese consumer. There are 1.4 billion people in China. 500 million of them are middle class. And then we've got about 200 to 300 of migrants that move around the country. And so I think that we need to stimulate demand within the middle class, as well as figure out ways to get that migrant population to increase their propensity to spend. There are things that they could do around safety net, permanence of homes, in terms of what's called a Hoku license, all the way to encouraging them to be able to save and to spend more. So they're levers. When you look at China, it's still a half fixed investment and exports, and then that other half that's supposed to be consumption is actually, it's been growing more slowly, and so there's some government policies that they can enact, particularly around the middle income as well as around the migrant population, that we think could actually be pretty incremental to growth if there was a real policy that was laid out around that.
People have been talking for years about the consumer aspect of the economy in China, that it's been underperforming,
right,
certainly compared to the United States, for example. How much of that is the drag of the home ownership?
Yeah.
That in fact they don't have enough money to spend?
So I think you have to look at it in absolute terms and then relative terms. So in absolute terms, GDP per capita has gone from 1,300 to 13,000 in the last 20 years. So on an absolute basis, those are huge, extraordinary gains. On a relative basis, what's happened though is the fixed investment and the export economy have just grown faster. I used to go back to China and took the banks public in 2000, and you were going to have greater growth in consumption. It just hasn't happened that way. Today, what most people don't understand about China is that the growth is coming from industrial automation as well as digitalization. That's about 20% of the economy, but it's over 50% of the growth. That's a misunderstood story. That growth is actually trumping consumption. In a world where we have higher trade barriers and we have geopolitical tension, the government's got to find ways to drive that consumption higher. And so on a relative basis, they either need to shrink the power that they're seeing through the automation and the industrialization and the digitalization, or they need to increase the consumption side. The consumption side is more of a subtlety. It's around policy, around childcare, around Social Security savings net, and around safety, where people feel inspired to spend.
How much of the drag on consumption is lack of confidence? And we talk about consumer confidence in the United States a lot.
Yeah.
What's it like in China?
It's been quite low. I mean, I've been going to China 30 years plus, but really what I saw since COVID until fall of 24 was a straight down decline. It feels like it's starting to improve, but all our models would suggest that what happens when you have a bank deleveraging and you have home prices go down, you get a longer unemployment cycle and you get less spending. And so you can't improve confidence until you get out of that deflationary pressure. And deflation right now is actually about minus 1%. So inflation is actually deflation of minus 1%. So your propensity is to wait to spend. So they need to kind of arrest that deflationary backdrop and make it inflationary. And I think that's something they're committed to, but they need to probably move more quickly.
You mentioned DeepSeek and that there's a big stir about DeepSeek over in China. Is that lending itself to capital investment? Is capital flowing in to artificial intelligence?
I think there was the first time in a while that I really felt the innovative spirit that I felt a decade ago was really starting to come back to life. And so I think there's still more that's going to have to be funded domestically than foreign. I think right now foreign investors are probably not apt to go in until they get some of their money out. But I think that people are watching and really paying attention from an investment standpoint for the first time. This group of people that came up with DeepSeek, they actually were no US born or US educated Chinese. It's all local. I think there's a deep source of pride in what they've accomplished. And I think the government's going to want to focus around the security of DeepSeek, but they clearly want to extend it into new industries and drive growth. And so Xi's goal is to create common prosperity. I think what you're seeing now, though, is a little bit of acceleration that creating some economic profits to fuel that common prosperity maybe is more tolerable than in the past.
Foreign direct investment has really dropped off in China. What will it take to bring it back? Where are there investment opportunities in China at this point?
I think when you look at the Chinese stock market, it's dominated by state-owned enterprises, and there's very few kind of just consumer companies, just basic consumer. Like if you look at the Indian market, there's more household names that both domestic and foreign investors want to own. I actually view that as an opportunity for China. China really got concentrated into their equivalent of the Mag 7, and then a lot of state-owned enterprises where they're overweight financial services. What we see over time when emerging markets really do well is they actually have companies, everything from just stable consumer products that the average investor investor can buy and hold for 10 or 20 years, and they can see that multiplier of the capital compound. And I think that's the opportunity set for China. So they probably need to do more in the consumer staples area, probably some on the entrepreneurial industrial side, as well as just consumer discretionary. They're clearly pushing tourism is a huge area of focus right now. Health and beauty is a huge area of focus. Things like pet care, a lot of things you see around the rest of the world. If they could get some of those companies public and allow investors to both domestically and internationally to access that, I think it probably would accrue to their benefit.
KKR has been in China almost from the very beginning. You have a long history there. Put what we're seeing today in China against the backdrop of the longer term view. I mean, right now there's a lot of up and down and tariffs and back and forth and trade wars. You can't tell from day to day exactly where we are. But if you take a longer term view, what is the future of China, particularly for investors?
I think when you look around KKR, our competitive advantage is in our global lens. We have 24 offices around the world. I think what we try to do, we run global PE, global infrastructure, global real estate, global credit. We're always looking for relative value. So there'll be times, we were in Japan for 7 years, we did one deal. And so we're there for the long haul. So even today, where it's a very slow environment, there's lots of information coming out of China that helps us both in China, but also in investments around the world. Right now, Japan and India are the big markets, but these things ebb and flow. When I started at KKR in 2011, nobody wanted to invest in the United States, and that was the opportunity set. So I think what we have to do is think long term, but also react to the cyclical pressures and watch the relative value, and things will accrue to our benefit for our LPs if we do that.
That does it for us here at Wall Street Week. I'm David Weston. See you next week for more stories of capitalism.
इस नेचुरल गैस को देखोगे तो सपोर्ट पर है, यहाँ पर एक बाइंग का प्लान कर सकते हैं नेचुरल गैस में। एंड अगर मैं अभी देखूँ क्रूड ऑयल में कैंडल ओपन इक्वल टू लो बन गई थी एग्जैक्टली, तो बाइंग बनती नहीं है वहाँ पे, ठीक है, सॉरी सेलिंग बनती नहीं है, कैंडल ही ओपन इक्वल टू लो है। नेचुरल गैस में एक बाइंग जरूर बनती है, ऊपर आएगा तो वापस सेल भी कर सकते हैं। माई स्क्रीन लुक्स फ्रोजन, नहीं तो स्क्रीन तो सही चल रही है, स्क्रीन इज फाइन, स्क्रीन इज वर्किंग फाइन कम्प्लीटली। ठीक है, यहाँ पर एक बाइंग का ट्रेड यहाँ प्लान कर सकते हैं। अच्छा फॉल कर गया है वैसे तो, बट एक छोटा सा टारगेट यहाँ तक का रखा जा सकता है। इससे ज़्यादा बड़ा टारगेट रखना मत। बाकी क्रूड ऑयल में देखो सेलिंग जरूर आ रही है, बट वहाँ पर सेलिंग बनी नहीं है डायरेक्टली। ये कैंडल देखोगे, ये बाइंग का टारगेट जब अचीव हुआ था, उसके बाद लुक एट दिस कैंडल, ये 530 वाली जो कैंडल थी जो रेजिस्टेंस पे पहली बार आई थी, ओपन इक्वल टू लो बना दिया था। ओपन इक्वल टू लो पे डायरेक्टली सेल नहीं करते हैं, इवन दो इट इज़ ऑन रेजिस्टेंस बट वी कांट सेल, रेजिस्टेंस पे सेल नहीं करते। बाकी ध्यान रखना है क्रूड ऑयल का चार्ट मेरा नेक्स्ट मंथ का है, ठीक है, क्रूड ऑयल का चार्ट मेरा ये नेक्स्ट मंथ का है, तो कंफ्यूज मत करना। थोड़ा सा वॉलेटाइल हो रहा है, देखते हैं एक ट्रेड फिर से अगर बनता है इसमें। बाइंग वाले तो निकल गए होंगे आई होप सो, एक छोटा सा ट्रेड था बाइंग का, एक सेलिंग भी प्लान थी बट कैंडल ही ओपन इक्वल टू लो बन गई। ओपन इक्वल टू लो नहीं बनती तो इसमें डायरेक्टली बाइंग जरूर बनता था, बट नहीं कर सकते अभी, वी नीड टू वेट। कि और कोई डेटा आज है नहीं, ठीक है, मेनली 5:30 न्यूयॉर्क सेशन था, अब 7 PM पे यूएस मार्केट ही ओपन होगा। ठीक है, क्रूड ऑयल में सेल मत कर देना कि लेवल पे सेल कर दो, उसमें सेलिंग की एंट्री बनी नहीं है, ठीक है, रेजिस्टेंस जरूर था बट वो कैंडल ओपन इक्वल टू लो बन गई तो उस पर सेल नहीं कर सकते। ब्रेकआउट भी हो चुका है तो सेलिंग वैसे भी नहीं बनने वाली, फेक ब्रेकआउट होता है वो बात अलग है, बट अदरवाइज बाइंग नहीं है। लेट्स सी अगर ये थोड़ा सा नीचे आ जाए, क्योंकि इसका ब्रेकआउट तो हो ही गया है, फेक ब्रेकआउट होता है तो एक बाइंग वापस ही कर लेंगे, सेलिंग तो नहीं है, नो। मिसेस एनीजी, आई एम गुड, आई एम गुड। मेरी स्क्रीन सही चल रही है, बता देना कमेंट बॉक्स में, स्क्रीन तो सही चल रही होगी या अभी भी फ्रोजन है। बाकी ये नेचुरल गैस में भी याद रखना, एंट्री लास्ट कैंडल पे नहीं हुई है, वो रेड वाली, वो भी ओपन इक्वल टू हाई थी तो उस पर डायरेक्ट एंट्री नहीं कर सकते थे। ये जो करंट कैंडल है उस पर एंट्री हुई है क्योंकि वो प्रीवियस कैंडल लेवल के ऊपर क्लोज हो गई थी, दैट इज वाई। ठीक है, क्रूड में कोई ट्रेड बनता है वो देखते हैं, अभी नहीं है, तो यूएस मार्केट भी ओपन होने वाला है तो लेट्स सी। रेजिस्टेंस यहाँ पर बनता है, लेट्स सी क्या करता है ये, सपोर्ट लेता है, फेक ब्रेकआउट करता है या फिर दोबारा बाइंग आती है, बट अभी तो नहीं है सेलिंग मेरे अकॉर्डिंग तो। आएगा तो देखेंगे बाइंग, नहीं तो ऊपर जाने देंगे, कोई फ्रेश ट्रेड उसमें तो नहीं है। बाकी नेचुरल गैस में भी ध्यान रखना, 7 PM पे यूएस मार्केट की कैंडल ओपन होगी तो उससे पहले मोमेंटम आ गया तो वेल एंड गुड, नहीं तो ट्रेल कर लेना, ठीक है। 15 मिनट है, इस कैंडल के बाद सिर्फ एक कैंडल और बनेगी तो ट्रेल द एसएल इन नेक्स्ट कैंडल। फिर 7 PM के बाद देखते हैं कितना मूव और करता है प्राइस। लाइक भी करते रहो गाइस, डोंट फॉरगेट टू लाइक द स्ट्रीम एंड सब्सक्राइब द चैनल।
As my birthday signals another milestone in my life, I'm hopeful that if I stay true to myself and follow my instincts, my legacy will be looked on kindly for generations.
COVID cases are surging in Asia. We're going to talk about that with our BI analyst, Sam Fazeli, next. This is Open Interest.
Exhausted investors digesting the latest tariff talk out of Washington.
Prepare.
In case you missed it on the opening trade.
How big a headwind is that going to be to my performance over the next 6 months, next 12 months? That dollar story, that dollar factor, that FX overlay.
Yeah, I don't think you can overstate the importance of this dollar shift. As we start to see a convergence of relative economic and profit growth rates, you are starting to see some of that overvaluation unwind, and it's shifting portfolio flows as well.
Don't miss the opening trade live every weekday.
All right, let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Let's get to high interest now. A look at what's making headlines around the world. Former President Joe Biden has been diagnosed with an aggressive form of prostate cancer that has metastasized to his bones. According to a statement from his office, the president and his family are reviewing treatment options with his physicians. Biden is 82 years old and left office in January as the oldest president in history. Israel's Prime Minister Benjamin Netanyahu says Israel will take over the entire Gaza Strip as the military carries out an unprecedented attack on Hamas. Netanyahu also said Israel would start allowing aid into Gaza, again, despite opposition from far-right members of the coalition who say it will help Hamas fund its war effort. Israel has been under intense international pressure to restart that aid. A report shows that about 1.6 million people in Gaza are facing food shortages. And New Jersey Transit reached a tentative deal with its striking union members on Sunday, but it's still a manic Monday for commuters. The deal didn't allow enough time for transit services to resume this morning. Financial firms like Citigroup and Deutsche Bank told employees that they could work from home or local offices. The leeway offers a partial reprieve from stricter return to office policies. Full operations are expected to restart tomorrow. Shonali?
And Matt, as you were mentioning before, makers of COVID drugs and diagnostic kits are climbing in U.S. pre-market trading. And that's on warnings from health authorities in Hong Kong and Singapore that cases are spiking. For more, we are joined by Sam Fazeli. He's Director of Research for Global Industries and Senior Pharmaceuticals Analyst for Bloomberg Intelligence. How significant is this uptick?
Well, it's not long ago that COVID wasn't doing what most respiratory illnesses do in the wintertime, i.e. just be confined to winter. In fact, right up to last year, there were two curves, two spikes in the US. So one around the wintertime where all the other ones come along with flu, et cetera, and then another one about 6 months later, about this time of year. Pretty much a lot of it coinciding with people being more sociable, or when the summer hits, they go indoors with aircon, etc. And also the fact that your natural antibodies tend to wane a little bit over that period, so you're more susceptible again. So that's, I think, probably what's going on here. I don't think this is a particularly worrying thing. It's a bit early because I don't know whether summer has already started in most of Asia, but I don't think it's surprising to see these two peaks, and the US has been seeing it.
What do we know, Sam, about the Novavax approval? Is this for everyone? Is it only for people over 65? Are there stipulations? How does it look?
Yeah, so Matt, there's two groups that have been stipulated in the actual approval. And remember, this is a full approval. This vaccine has been under emergency use. Remember those days? It's emergency use authorization, just like the mRNA vaccines. It just took a lot longer than them to get past this point of getting full approval. And in the end got it. And it is for 65 and above, and those at high risk of catching the disease in terms of their complications between the age of 12 and 64. So when you look at that group, those are probably the same people who've been taking it anyway in the recent past. So it's a good position for them to be in. Probably a little bit late to see major money flowing in from contracts. 2026 will be the year we'll see how effective it competes with the mRNA vaccines.
In a lot of ways, many people are anticipating COVID season, sort of like they would anticipate the flu. How much are people taking these vaccines? What does the uptake look like?
Yeah, so I think the uptake has been declining year after year after year. For whatever reason, is it the sorts of conversations that are being had by some people about, well, you don't need it anymore, we've got natural immunity, etc. But I think even amongst those who should take it, there is a small percentage. There's only a small percentage that do take it. Don't forget, flu has been with us for much longer, and it's still hard to push it past 30-40% coverage of those who will benefit from it. So it's a tough sell, this getting vaccines to people where they need it.
All right, Sam, great to get the intel from you. Really appreciate it. Sam Fazeli runs our Bloomberg Intelligence operations out of Europe and focuses in on pharmaceuticals. Let's get a quick check on futures ahead of the opening bell. We're still looking at big drops. S&P futures down 1.1%. NASDAQ futures off 1.5%. But remember, we had a fantastic week last week with a 5% plus gain on the S&P 500. Also getting headlines across from PepsiCo saying that it is going to complete its purchase of Poppi, which is a maker of some kind of, I guess, healthier form of
probiotic soda.
Probiotic soda. And you can see, Pepsi kind of fighting the drop today with a little bit of a gain in the pre-market. We'll see how that goes at the open.
Yeah, but it's interesting. We've seen the sell-off get more stark as the morning went on. We were down less than 1% when we started this show.
That's right.
Where sentiment is today.
We'll come back and see what Sinead Colton Grant thinks about Mike Wilson's advice to buy the dip. She sees the S&P 500 finishing the year around 6,200. So maybe she's into it. This is Open Interest.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Up-to-the-minute financial and geopolitical news whenever and wherever it happens. I'm Francine Lacroix in Davos, Switzerland, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
In case you missed it, on The Pulse.
I see more and more European suppliers that are becoming aware of the need to increase the pace and to offer something unique. So if, let's say 2-3 quarters ago, I was them more in a wait and see, now I see more reactive. We have some Chinese supplier, yes. Are they making strategic component? Not. I think that there is nothing more than that.
Don't miss The Pulse, live every weekday.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything.
It is a fact that if you put the aggregate of the policies undertaken right now, most of the world wants to diversify in a meaningful manner while keeping a healthy exposure to the U.S. There's no way you can cut exposure to the U.S. and get respectable returns, certainly in the equity markets.
Venu Krishna of Barclays casting doubt on the Sell America narrative. Joining us now at the desk, BNY Chief Investment Officer of BNY Mellon, Sinead Colton Grant. Which side are you on here? Because it's interesting. We're seeing the market have that Sell America narrative come back into it. But you have Venu Krishna, you have Mike Wilson coming in saying this is a good time to get in.
Look, we've taken out a lot of left tail risk over the last 4 weeks. So actually, we're a lot more constructive. Our expectation of the odds of recession is now down to 25%. We see earnings expanding for the full year around 9%. So look, the S&P could, at the upper end, finish around 6,400, even higher than the 6,200 midpoint. So we like it.
Surveillance had Mark McCormick on this morning from the Toronto Dominion Bank, TD. And he was saying that one of the effects of this deglobalization, reindustrialization we're going through is that foreign investors will be taking money out of U.S. assets, taking their investments out of the dollar and looking for other things at a time when we need it most, right? That kind of investment. What do you think about that argument?
This is where I think you need to be really careful about traditional economic views overtaking what is the rational fundamentals, right? So think about productivity growth in the U.S. relative to most other developed markets. It is at least double over the last 5 years. And that also extends back through for really the period since the financial crisis. So you think about productivity growth, you think about the innovation that happens in the U.S. I think it's pretty tough to bet against the U.S. as a location for investment. Do you want to invest outside the U.S.? Of course, because you want a diversified portfolio, but you certainly don't want to bet against the U.S.
Sinead, you're sticking with us. That is BNY Wealth. Sinead Colton Grant sticking with us through the open, just a few minutes away. But a check on futures ahead of the opening bell, because yes, we are down in the U.S. That Sell America trade, as you've been talking about, has been taking off a little bit this morning. But the NASDAQ 100 down more than the S&P 500 in terms of futures movement, 1.5% on the big tech index. Russell 2000 down about 1.7%. And the S&P 500 has been gaining steam in the slight sell-off. But as you've been saying, Matt, it was a good week before. Maybe people are just taking a few chips off the table.
Absolutely fantastic week last week. We closed at 59.58 on the S&P 500, so more than 200 points above where we were April 2nd.
6,000.
We're okay, but we're still higher on the year. We'll come back with the opening bell. This is Open Interest.
First time, or got to many times go visit with Steve Jobs to try to get an Apple box to be our box. And we were trying to merge boxes. And of course they have Apple TV, we have our box. Never actually happened. And in one of the meetings he said, well, you should give up because we're going to win that. But you should put Wi-Fi in all your boxes. And that's how you'll win. And you should be the best pipe. And he said the best dumb pipe. So I went home, went to our chief technology officer and said, what's Wi-Fi? And today we have the nation's biggest Wi-Fi network. And we have more customers. And 90% of your cell phone usage, 90% is Wi-Fi.
Right.
And that's because 70% of all the bits going over the internet right now are streaming. And streaming wasn't here 10 years ago. So I sit here and say the most exciting thing about our company is what's coming in the next 10 years that happens in innovation around the world, hopefully here in America, hopefully Silicon Valley, in LA and everywhere else, Philadelphia, and that we're going to continue to have bits per home go up.
be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We are moments away from the start of trading on this Monday morning. It looks like that downgrade is going to lead to a sell-off. Is it a buying opportunity? A question we're putting to our guest today. S&P futures down more than 1%. NASDAQ futures off 1.5%. Small caps falling even further right now. You hear the opening bell down the New York Stock Exchange. An unfortunate ticker, UTI, ringing the bell there. But the shares are up 34% year to date, and they're up like 400% over the past 5 years. That makes up for the ticker they chose, Universal Technical Institute, worth about $2 billion and climbing. A $2 billion biotech firm, Ligand, ringing the opening bell at the NASDAQ. Shares are basically unchanged, I think down about 2% year to date. In terms of the stocks that we're watching, Shonali, you've got a big one here.
I do. And NVIDIA down more than 2%. They will allow customers to use rival chips as part of their AI efforts in a move that's going to further expand its ecosystem across data centers. But shares are falling in line with broader markets this morning. And Matt, it's really big tech that is leading the way in that sell-off in the market today.
Yeah, I think NVIDIA is just illustrative of the Mag 7 pulling the market down today. They pushed it up last week. Vaccine makers are swimming against the grain or upstream. I'm guessing mixing my metaphors a little bit, but they're up. After COVID cases spike in Hong Kong and Singapore, Novavax just got FDA approval for its COVID vaccine. So they're up big, 27%. If you broaden it out, Goldman Sachs says it is getting more bullish on big tech. The strategist David Kostin says, we continue to expect that superior earnings growth will drive the Mag 7 to outperform the S&P 493 in 2025. That is the rest of the index, but by a smaller magnitude than in recent years. Let's bring back in BNY Wealth, Sinead Colton Grant. So we saw this Mag 7 spurring an almost 20% gain in the S&P 500 from the April 2nd lows. Does that continue?
Well, look, we think it does. One of the things that we were looking out for in the Q1 earnings season was any moderation in spending around tech related to AI. That is continuing. That's going to continue to boost those stocks. But let's also realize what we're seeing. They're much higher beta. They are far more responsive to any changes in market sentiment, and that continues through to even this morning.
We thought they were defensive. Remember the last few years?
Big cash hoards, cash is yielding a lot.
Are they not anymore? Because they seem to get hit by these macroeconomic trade winds just as much as everybody else, if not more.
Well, some of it is about the fundamentals, right? If you're expecting yields will be higher for longer, then that's going to have an impact on valuations. But it's also about supply chain and tariffs and, in particular, exposure to China.
When you think about the headwinds, I know we're looking at opportunities. There's actually a little bit of bullishness that the worst is over. But if you have yields higher, that means cost of financing is higher. If you have the president saying companies need to bite the tariffs, they need to absorb the costs, and margins are under pressure. At what point does this reset valuations to the point where upside becomes hard to find?
Well, look, this is where you really start to see which companies are the better run companies, right? Who's going to do a better job at having suppliers?
Any news in crude oil? पता नहीं न्यूज़ का कुछ आई तो नहीं. ऐसी कोई न्यूज़ तो आई नहीं. बाकी देखते हैं इसमें कुछ नया ट्रेड बनता है तो. ये कैंडल यहाँ पर ओपन इक्वल टू लो बन गई थी 530 वाली, उसके बाद से मोमेंटम ही है. देखना पड़ेगा अब क्या करता है ये. अगर ऊपर आया है तो यहाँ पर एक सेलिंग बनेगी. कैंडल का ध्यान रखना, ओपन इक्वल टू लो नहीं बनना चाहिए. अगर थोड़ा सा नीचे आता है नॉर्मल कैंडल बना के, तो फिर एक वापस बाइंग का ही प्लान कर लेंगे. यहाँ पर नहीं कर पाएंगे, थोड़ा सा हैसल बड़ा हो जाएगा नहीं तो. क्रूड ऑयल का ध्यान रखना, ये करंट मंथ का चार्ट नहीं है, नेक्स्ट मंथ का चार्ट है क्रूड ऑयल का।
Look interesting. They could potentially be very big beneficiaries of the spending from the EU. We do like some of the alternative infrastructure plays like cell towers, data centers, and those are some of the areas that we like, particularly in Europe. We're still cautious on China. We just think the economic growth headwinds are very significant, and despite the stimulus package, there's just a lot to overcome in terms of the hit to consumers from not only pandemic-related depletion of spending, but also just the impact on the property sector.
But does that mean all of EM? Because last week, Michael Hartnett said there's no better place to bet this year than emerging markets.
Emerging markets, we would still exclude China. We think there were too many headwinds, both geopolitical and economic there. But outside that, yes, you've got exposure to some of the fastest growing economies, particularly when we think about India. And there are some interesting markets in Latin America too.
So for the people that are looking at the Sell America trade today, maybe looking at the diversification a little bit more seriously, you're still looking at a DAX up almost 19% on the year. You're looking at the FTSE 100 up about 5%, the S&P 500 only up about 0.6%. On a relative value basis, that trade into Europe, you've seen it. Is there much more to be had?
Well, that's the big question, and we're not sure that there is, because there's been a huge amount of euphoria so far year to date. But let's remember, Europe is still incredibly highly regulated. And when we look at productivity numbers over the last decade, productivity in Europe has essentially been flat, and we think a lot of that is to do with just the degree of regulation. So again, a lot of euphoria. We think a lot of it was triggered.
यूएस मार्केट ओपन हुआ है, याद रखना पहली जो भी कैंडल बन रही है यूएस मार्केट की ओपनिंग कैंडल ही है, तो थोड़ा सा वॉलेटाइल कैंडल होगी किसी भी साइड मूव कर सकती है.
If you are a dollar investor, is up 30% year to date.
Okay.
The same is true of like the IBEX and the FTSE MIB. Southern Europe has crushed it. If you're a dollar investor, right, because of the gains that you've got from the euro.
Yeah, absolutely. Sinead, we got to leave it there. That is BNY Mellon's Sinead Colton Grant. We thank you so very much. We're going to also get a check here on some movers right now, because we are looking at a down day on the S&P 500 generally, but not all the way around. We're looking at on a points basis, actually some of the big tech holding up. Microsoft, the biggest points gainer on the day. Interesting to see that stand out against the crowd when a lot of big tech has not been doing so well. United Health getting some reprieve. Remember, this has been a tough stock to be in throughout the year, but on a points basis, now up, but only up on a percentage basis, about 0.3%. On the downside, this is what I've been talking about here. Apple, consumer-sensitive technology stocks really feeling the pain. Apple down more than 3% today. Tesla down more than 4% today. Nvidia still down about 1.2%, but maybe the pain right now not as bad as it had been earlier in the morning. Taking a look at sectors here as well, as we've been saying, yes, big tech really leading the way, but energy even more so, down more than 2%. This has been a fascinating trade this year. You could just see how broad-based the decline is here and where the sentiment stands. Healthcare is really the only place you're seeing some gains. Remember, Matt was talking about COVID linked linked stocks, vaccine stocks really feeling some of that gain because of those cases seen over in the Asia region. But really, this is defensive. And Matt, we got to see how this holds through the day. Remember, it's really a bond investors kind of day, but the stock market feeling that sell America trade too.
Yeah, absolutely. Healthcare and staples, industrials rising. Coming up, Walmart stock slumps after drawing the ire of President Trump. We'll take a look behind the animosity next as he tells them to eat it. This is Open Interest.
Overbought territory, a technical testament to that dramatic snapback in sentiment over the past 5 weeks, as a lot of folks got a sense that the trade war might not be as painful as thought. The Atlanta Fed's running estimate of real GDP growth for this quarter, that's actually back up to 2.3% now after being as low as 1.1% just 2 weeks ago. But as Jamie Dimon said earlier today, we're not quite out of the woods.
I'm going to defer to economists who give it about a 50% chance. I think all these things are probably inflationary a little bit more and slowing down the economy. If there's a recession, I don't know how big it'll be or how long it'll last. Hopefully we'll avoid it, but I wouldn't take it off the table at this point.
And really, the crystal ball remains cloudy for everyone out there, and today really showed why. You had multiple economic data points sending multiple and conflicting signals. U.S. factory production declining for the first time in 6 months, but weekly jobless claims remained unchanged. Retail sales growth, that slowed as consumers cut back on cars and sporting goods. However, wholesale price inflation, that unexpectedly declined by the most in 5 years. But if the economic data is unclear, the commentary from C-suite executives, that's a bit more blunt. Walmart, which has aggressively cultivated a reputation as the value-oriented retail stock, said it can't hold the line much longer on absorbing those tariff-related cost increases and may have no choice but to start raising prices for shoppers as soon as this month, Scarlett.
Yeah, and that's something else for investors to sift through as they go through all that mixed data as well. So they're now dealing with signs that the growthy part of the market is overbought. This is something you referenced. Take a look at this chart. The white line is the S&P 500. The NASDAQ 100 is the blue line. And less than 1 month ago, you saw the NASDAQ, the NDX, sitting at a one-year low and technically oversold. That is below the green line there. Since then, it has surged 25% and entered overbought territory, which is marked by the red line. The S&P 500, that white line, just on the cusp of entering overbought territory as well. Now, this is a contrarian indicator, which means being overbought simply makes it more vulnerable to a pullback. But as you can see from last year, the index can stay overbought for a while before seeing a sustained downturn. Romain?
All right, as we kick you off to the close here on this Thursday afternoon, we want to bring Scott Cronert into the conversation, U.S. equity strategist and global head of ETF research over at Citi. And I know that a big part of the rally, Scott, that we've seen over the past few weeks has been a little bit more technical in nature. But I am curious if there is a fundamental case to be made for the continuation of this rally, in your view.
Oh, I think there definitely is a fundamental case. It's just going to take some time to play out. I think the chart that Scarlett just showed is sort of mission critical.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call.
Clearly in jeopardy. As a function of materially higher tariffs. Now, we've walked back from that cliff, as you will, to something that's less onerous, but it's still not clear. A 10% effective tariff rate, just factoring that in as a baseline case, still creates a headwind for fundamentals for the S&P 500. And as you go into the ongoing budget negotiations, signs of economic slowing, as you're already pointing to, I think we have to allow that there's an opportunity for the S&P to digest some of the recent gains.
I am curious, though, too. I mean, and it's curious that you bring up the tax bill, because I know a lot of folks in Congress, on Wall Street, have been waiting to see a little bit more progress when it comes to some of these fiscal proposals, whether it's dealing with the budget deficit or these tax cuts, et cetera. If we do get a little bit more clarity on that and Congress is able to move this forward, and presuming that the tariff trade war doesn't heat back up to the extremes that it was just a few weeks ago, is that going to be enough to sort of placate investors in the meantime, or are they still, do you think, maybe going to be sitting on the sidelines?
I think the storyline very quickly, even though we're mid-May, the storyline is going to quickly move to how much of an earnings snapback can you get in 2026. Now, right now, we're projecting earnings growth for next year somewhere in the low teens, 13, 14%, not too far off of where consensus goes. So the discussion point around all of this is that we've been to the precipice on tariffs. We've walked back. We're still navigating where we go with the budget process and where that takes the deficit math. But all told, what the opportunity for equities here is that as you turn the mid-year corner, begin to go through the back half, eyes usually pivot to the out year, right? And so if we're able to look at a fundamental and economic valley right now that leads to growth coming out the other side, yes, that's where you get more constructive on U.S. equities. That's what's more or less reflected in our bull case, not our base case. But
वो देखो यूएस मार्केट ही कैंडल क्लोज हो गई है, कोई डेटा नहीं है आज, ध्यान रखना। तो मार्केट हो सकता है किसी न्यूज़ पे इम्पैक्ट डाल दे। क्रूड में अभी कोई ट्रेड नहीं है, यहाँ पर कुछ नहीं कर सकते। एक सेलिंग का ट्रेड यहाँ पर प्लान कर सकते थे, बट वो कैंडल ने पूरा स्ट्रक्चर खराब कर दिया, ओपन इक्वल टू लो बना के। अब देखते हैं कुछ नया स्ट्रक्चर बनता है तो ऊपर चला जाता है तो यहाँ एक सेलिंग का प्लान जरूर रहेगा। ओपन इक्वल टू लो नहीं बननी चाहिए कैंडल, नीचे आता है तो एक सपोर्ट है। बाकी और देखेंगे, और तो इसमें और क्या कह सकते हैं। एक बार फॉरेक्स का चार्ट देखना पड़ेगा इसके लिए पहले। May 16th फॉरेक्स में तो पूरा वॉलेटाइल है, बताओ। ये तो नहीं है कहीं से भी। 23, 15, 23, 15, नोप, कहीं से ये है कि रेट। यहाँ से मार्केट ले चुका है 2 बार रेजिस्टेंस। अब एक तो ये अपने यहाँ पर भी इसका एक रेजिस्टेंस बना हुआ है शायद फॉरेक्स में। वहाँ पर अर्ली मॉर्निंग पे जब मार्केट ओपन हुआ था, पहली कैंडल ही वहीं से रेजिस्टेंस ली थी 330 की आज। फिर दोबारा आया था 445 पे। अब ये थर्ड टाइम वहीं से सेलिंग आई है वापस। एक और है वहाँ पर भी रेजिस्टेंस है। एमसीएक्स में नहीं दिखेगा क्योंकि गैप डाउन है सीधा। बाकी कैंडल याद रखना थोड़ा सा, एमसीएक्स में कभी अलग बनती है, फॉरेक्स में कभी अलग बनती है, ठीक है। जैसे अगर मैं बात करूं तो यहाँ पर कोई रेजिस्टेंस नहीं है फॉरेक्स में, लेकिन एमसीएक्स में है। थोड़ा सा पुल बैक आता है तो यहाँ पर कोई सपोर्ट नहीं है एमसीएक्स में, लेकिन फॉरेक्स में, लेकिन एमसीएक्स में था। तो प्राइस उसी के अकॉर्डिंग मूव करता है। तो अब देखते हैं क्या करता है। थोड़ा ऊपर और आ जाए तो एक ट्राई और कर लेंगे ऊपर से सेलिंग के लिए। नहीं तो नीचे ही आए अब, और तो इसमें कुछ बचा नहीं है। नीचे कोई फ्रेश लेवल है नहीं। एक चार्ट अलग ही चल रहे होते हैं, बताओ। एक बार सेलिंग आई, दूसरी बार आई लोअर लो बनाई, तीसरी बार आई वो सपोर्ट नहीं बना, तो यहाँ से वापस सेलिंग आ जानी चाहिए लॉजिकली। एमसीएक्स में देखोगे, फॉरेक्स में एमसीएक्स में सीधा फिर 5364 के अराउंड रेजिस्टेंस है। और जरूर जाएगा ये। 30 कैंडल देखो जरा, इसमें इसके ऊपर कुछ रख लो, वहां से मिल सकता है। यहाँ पर भी आया तो नहीं है ना। ऊपर है तो इसी को लिया जाएगा। अगर इसको नीचे आना तो ये पहले हो सकता है सपोर्ट ले, हो सकता है रेजिस्टेंस ले, अदरवाइज साइडवेज भी जा सकता है। इस केस में लेट्स सी, इसको एक ट्राई करने के लिए प्लान होगा। और तो इसमें कुछ नहीं है भाई, दैट इज द ओनली लेवल। लाइक भी करते रहो गाइस, लाइक रुकने नहीं चाहिए, ठीक है। डोंट फॉरगेट टू लाइक द स्ट्रीम एंड सब्सक्राइब द चैनल। जिन लोगों ने सब्सक्राइब नहीं किया, शेयर विथ योर फ्रेंड्स एंड फैमिली मेम्बर्स। शेयर भी करते रहो अपने दोस्तों के साथ। कोई क्वेश्चन, कोई डाउट होगा तो कमेंट बॉक्स में पूछ सकते हो। यू कैन आस्क इन द कमेंट बॉक्स।
I will say that the tone is absolutely more guarded, more difficult, and many clients are really putting allocations that they had planned on pause for the moment until there's more clarity. So we, came into the year where there was quite a lot of optimism, I would say. People really felt that U.S. exceptionalism was carrying on. They felt pretty good about the economy. The proportion of people who felt we were headed for a recession had fallen a lot. And what a shift in just a couple of months, and particularly in that first 10 days of April. So I would characterize our clients as they're pausing. They want to wait and see. They aren't taking action, so we don't see people selling. But they are not carrying on with the overweight they had in the U.S. The way that they were even 4 months ago. And they have absolutely paused on some of the risk assets that were coming back, like real estate. So we're in a pause period.
A pause period. What gets us out of that pause? Is this really just all about a tamp down in trade tensions, or is there more to it?
No, there's more to it than that. I think that people are all of a sudden fundamentally reassessing the allocations that they've had. So our clients over the last couple of years have had an over-allocation to the U.S., and they were nervous about it, but ultimately didn't see what a viable alternative was, and so kind of got themselves comfortable with it. I think they are rethinking that. They are thinking maybe we go back to our long-term averages. There's still, many of them are 5-8% above where they were. And maybe actually they want to go back to that, which will largely be done by new allocations, I think, rather than selling existing. But you are seeing people think it's not just tariffs. We don't really know what tax policy will be here and what actually fundamentally does get through the administration. So there's a lot of unknowns that I think people feel that just uncertainty is at a much higher level. The risk premium is higher, and therefore they're going to demand a higher return.
So animal spirits have certainly been muted.
Yeah.
Talk about the long-term changes that your industry has faced as you close out your tenure at PGIM. I mean, what have you put in place to position PGIM for the gold rush that we're seeing into private assets, especially at the retail level and at the wealth management level?
Sure. So I think that the biggest change over the decade has been that the world used to be divided into two. There was the kind of long-only managers that did stocks and bonds, and then there was the private equity guys who did privates, and increasingly they expanded beyond kind of private equity into private credit and into real estate. Those are coming together. There really is not two distinct ecosystems. There's not two distinct groups of clients that just want to talk about privates, publics. It's all coming together. And I think what I have tried to do at PGIM is actually to dramatically build out our private alternatives capability, because I really saw the fact that these were coming together. Our clients want to deal with large global players who offer privates and publics together and can create solutions out of it.
Part of our conversation that we had with PGIM Chairman David Hunt, of course, just stepping down as CEO of the asset management firm at the start of this month, Scarlett. And it was kind of interesting to kind of bookend his career, because I'm told that the very first interview that you did with him was back 11 years ago, right?
Yeah, that's right. It was when we went to Milken, I believe, and it was his first big TV interview. So I guess he wanted to bring it full circle.
Yeah. All right. Well, cool. It's very nice, and I was just a wonderful man. And of course, we'll keep tabs on where he goes next. When we come back, we're going to refocus
said no golf,
on.
though.
I know that kind of annoyed me, though. He said he's a tennis guy. Anyway, we're going to focus a little bit more on what's been going on in the world of public equities, and that includes Walmart. The share is down fractionally on the day.
News when you want it with Bloomberg News Now. I'm Nathan Hager. A new trading week is underway on Wall Street days after Moody's Ratings stripped the U.S. of its last top credit rating. Stocks are opening lower. That was the sound of the opening bell from the floor of the New York Stock Exchange. At the open, the S&P 500 is down 1%, down about 60 points, trading right around 5,900. The Dow Jones Industrial Average opens about 0.7% lower, of more than 275 points. And the NASDAQ Composite leading the declines, down 1.4%, or nearly 270 points. The 10
देखो थोड़ी देर पहले की न्यूज़ है, मैं अभी देख पा रहा हूँ इसको। अराउंड 4 PM पे आ गई थी, सॉरी 5 PM के अराउंड, इंडियन टाइम के अगर अराउंड देखोगे तो 5:56, ठीक है, 6 बजे के आसपास की ये न्यूज़ है, अभी दिख रही है, जहाँ पर इजराइल ने कहा है, इजराइल के जो प्राइम मिनिस्टर हैं बेंजामिन नेतन्याहू, उन्होंने कहा है कि इजराइल टेक ओवर करेगा पूरे गाजा को, मतलब जो पूरा गाजा है नाउ पार्ट ऑफ द इजराइल, एंड उसके बाद हम एड वहाँ पर जो आ रही है उसको आने देंगे वापस। एंड लेट्स सी एंटायर गाजा स्ट्रिप को किस तरह से टेक ओवर करते हैं। एंड इसके अलावा वहाँ की जो मिलिट्री है उन्होंने भी कहा है कि वो एक अनप्रेसिडेंटेड अटैक करने वाले हैं हमास के ऊपर। आई डोंट नो किस तरह का ये अटैक होगा, बट दैट इज़ अगेन न्यूज़ विच मुझे लग रहा है शायद ये यहाँ पर जो एक कैंडल बनी है ये उसी का इम्पैक्ट है, दिस वन आई थिंक, जो वॉलेटाइल कैंडल बनी है उसी का इम्पैक्ट है शायद, क्योंकि न्यूज़ थोड़ी सी बुलिश है प्राइस के लिए देखा जाए तो, क्योंकि अगर ये पूरा गाजा को अपने कवर में ले लेते हैं तो उससे बहुत बाकी जो कंट्रीज़ हैं आसपास की वो वो नाराज़ हो सकती हैं, हो सकता है अमेरिका भी साथ ना दे, देखना पड़ेगा। बट ये स्टेटमेंट इजराइल के प्राइम मिनिस्टर की ओर से आ गया कि इजराइल विल टेक ओवर एंटायर गाजा स्ट्रिप। प्राइम मिनिस्टर बेंजामिन नेतन्याहू said on Monday as the military announced it would carry out an unprecedented attack on Hamas. Let's see, कुछ इसमें न्यूज़ इन डेवलपमेंट रहेगी तो देखेंगे वापस से। Netanyahu said that alongside the increased attack, Israel would start allowing aid into Gaza again after stopping it in early March. International pressure has mounted on Israel to restart it. The United Nations पूरी गाजा स्ट्रिप को कैसे निकाल देते हैं, देखते हैं, क्योंकि गाजा स्ट्रिप में बहुत सारी चीज़ें आती हैं। गाजा सिटी है, वहाँ पर खान यूनिस है, रफ़ा क्रॉसिंग जो मेन जगह है। अगर ये हुआ तो इजराइल फिर से एक्सपेंड कर लेगा। तो ये एक न्यूज़ है, मेजर न्यूज़ कह सकते हो, जिसका इम्पैक्ट क्रूड ऑयल पे हो सकता था या हुआ है मेरे अकॉर्डिंग तो। लेट्स सी।
There you could see a lot of volume gain.
News when you want it with Bloomberg News Now. I'm Nathan Hager. A new trading week is underway on Wall Street days after Moody's Ratings stripped the U.S. of its last top credit rating. Stocks are opening lower. That was the sound of the opening bell from the floor of the New York Stock Exchange. At the open, the S&P 500 is down 1%, down about 60 points, trading right around 5,900. The Dow Jones Industrial Average opens about 0.7% lower, or more than 275 points. And the NASDAQ Composite leading the declines, down 1.4%, or nearly 270 points. The 10-year Treasury yield is up nearly 6 basis points to 4.53%. The long bond, the 30-year, is at 5%, its highest level in 18 months. At the White House this morning, National Economic Council Director Kevin Hassett said American bonds are still the best buy. He says they'll be even better once President Trump's policies are in place. But Atlanta Fed President Raphael Bostic says the Moody's downgrade could have a negative impact on companies and households looking to borrow. Bostic made those comments on CNBC this morning. We get more from Bloomberg's Michael McKee.
The state of the economy is topic number one here. Everybody's trying to guess at what will happen, and now you throw on the added complication of the Moody's downgrade, and it just makes things more uncertain.
Bloomberg's Mike McKee will get more from Raphael Bostic later today at the Atlanta Fed's conference in Amelia Beach, Florida. You can catch their conversation this afternoon at 2:45 Wall Street time on Bloomberg Radio, Bloomberg Television, and the Bloomberg Podcasts YouTube page. Ahead of that, we're expecting a phone call between Presidents Trump and Putin this morning on ending Russia's war in Ukraine. We get more on that from Bloomberg's Oliver Crook in Berlin.
This is something that the Trump administration has been putting increasingly pressure on. The Europeans got on board with it. The Ukrainians trying to get that 30-day ceasefire, with which Putin rejected last week. We had these sort of talks in Turkey that led to nowhere. And the idea now is that Donald Trump will try to break through that deadlock and try to advance the conversation around the ceasefire.
Bloomberg's Ollie Crook, and ahead of the call, sources tell Bloomberg News that Putin feels like he has a strong hand, that his forces can break through in 4 key Ukrainian regions before the end of the year, and that he's not likely to offer meaningful concessions today. President Trump's so-called big, beautiful tax and spending cut bill has taken a big step forward in the House. We get that update from Bloomberg's Bill Ferries.
It was just maybe about an hour before midnight last night when the House Budget Committee approved this legislation, with the 4 ultra-conservative holdouts basically voting present, so allowing this legislation to pass, to take the next step.
Bloomberg's Bill Ferries reports that next step will be another late-night vote in the House Rules Committee. That's set for 1 a.m. this Wednesday. House Majority Leader Steve Scalise says the bill brings work requirements to Medicaid in 2 years rather than 4. Several Republicans in the Senate oppose any moves to cut Medicaid. In the Middle East, a delegation from Hamas is in Iran's capital, Tehran, for talks with the foreign minister and other officials. It is the first visit to the Palestinian group's key backer since February. It comes as Israeli Prime Minister Benjamin Netanyahu has promised to take over the entire Gaza Strip and carry out what he's calling an unprecedented attack on the enclave. Vice President J.D. Vance met this morning with Pope Leo XIV a day after his inaugural Mass at the Vatican. The vice president talked about the first American pope during meetings with European leaders yesterday.
Of course, an American pope. The United States is very proud of him, very thrilled with him, and certainly our prayers go with him as he starts this very important work.
This morning, Vice President Vance gave the Chicago-born pontiff an invitation from President Trump to visit the U.S., plus a Chicago Bears T-shirt with his name on it. Former President Joe Biden is thanking Americans for their love and support after he announced he's in for the health fight of his life. Bloomberg's Laura Davison has that from Washington.
He was announced over the weekend that on Friday he was diagnosed with an aggressive form of prostate cancer. The family right now is evaluating treatment. It's possible that this could be, hormone therapy or potentially something as strong as chemotherapy. But a lot of well wishes from President Trump, as well as many in Washington, to the Biden family in recent days.
That's Bloomberg's Laura Davison in the nation's capital. Back on Wall Street, we're watching shares of NVIDIA. They're down nearly 2% at the open after the AI chip giant outlined plans to let customers use rival chips in data centers built around its technology. We're also watching Walmart this morning. Those shares are down more than 1.5%. President Trump is urging the world's biggest retailer to, in his words, eat the tariffs. And Novavax at the open is soaring by 26%. Regulators in the U.S. have fully approved Novavax's COVID vaccine. That's news when you want it with Bloomberg News Now. I'm Nathan Hager. This is Bloomberg.
You're listening to an iHeart podcast.
Inflation actually cooler than anticipated. What's the takeaway?
Well, so I think, retail sales were muted because this is the April data that we just got. We know that there was some front loading ahead of the expectation that tariffs would hit prices. I think there's more front loading to come that's going on this month. So I think when we get retail sales next month also, we'll probably see a little bit of that front loading continue. But really, in terms of the inflation data,
नेचुरल गैस में कैंडल का ध्यान रखना, ओपन इक्वल टू हाई है। से ओपन इक्वल टू हाई बन गई है कैंडल। नेचुरल गैस है सपोर्ट पर ही, बट जगह पे ओपन इक्वल टू हाई बन रही है। अब कोई डेटा नहीं है, देखते हैं मोमेंटम कितना करता है मार्केट आज।
end of the day, that is double what they were in January. When you look at on a trade.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A bet on the economy or a bet on the Fed? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S., a fire hose of data to sift through today.
Absolutely.
All right, well, let's take a look at where markets stand right now. Stocks open lower but turned positive in the late morning, really have not looked back. The S&P 500 currently up 1/3% right now. And this is without the help of big tech. The Mag 7, as you can see, down 1% as a group, more than 1%. That's the first decline in about 6 days' time. The real action, though, across the markets is in the yield space. Bond yields are sharply lower here. You can see the 2-year coming down almost 8 basis points, the 10-year down 8 basis points, thanks to a coolish wholesale inflation report and also weaker retail sales.
59.12 right now, Scarlett, on the S&P 500. Quite astonishing given where we were just a few weeks ago. And really hard to believe that a month ago, U.S. equities were actually deeply oversold. Yet today, they're cracking into overbought territory, a technical testament to that dramatic snapback in sentiment over the past 5 weeks, as a lot of folks got a sense that the trade war maybe might not be as painful as thought. The Atlanta Fed's running estimate of real GDP growth for this quarter, that's actually back up to 2.3% now after being as low as 1.1% just 2 weeks ago. But as Jamie Dimon said earlier today, we're not quite out of the woods.
I'm going to defer to economists who give it about a 50% chance. I think all these things are probably inflationary a little bit more and slowing down the economy. If there's a recession, I don't know how big it'll be or how long it'll last. Hopefully we'll avoid it, but I wouldn't take it off the table at this point.
And really, the crystal ball remains cloudy for everyone out there, and today really showed why. You had multiple economic data points sending multiple and conflicting signals. U.S. factory production declining for the first time in 6 months, but weekly jobless claims remained unchanged. Retail sales growth, that slowed as consumers cut back on cars and sporting goods. However, wholesale price inflation, that unexpectedly declined by the most in 5 years. But if the economic data is unclear, the commentary from C-suite executives, that's a bit more blunt. Walmart, which has aggressively cultivated a reputation as the value-oriented retail stock, said it can't hold the line much longer on absorbing those tariff-related cost increases and may have no choice but to start raising prices for shoppers as soon as this month, Scarlett.
Yeah, and that's something else for investors to sift through as they go through all that mixed data as well. So they're now dealing with signs that the growthy part of the market is overbought. This is something you referenced. Take a look at this chart. The white line is the S&P 500. The NASDAQ 100 is the blue line. And less than 1 month ago, you saw the NASDAQ, the NDX, sitting at a one-year low and technically oversold. That is below the green line there. Since then, it has surged 25% and entered overbought territory, which is marked by the red line. The S&P 500, that white line, just on the cusp of entering overbought territory as well. Now, this is a contrarian indicator, which means being overbought simply makes it more vulnerable to a pullback. But as you can see from last year, the index can stay overbought for a while before seeing a sustained downturn. Romain?
All right, as we kick you off to the close here on this Thursday afternoon, we want to bring Scott Cronert into the conversation, U.S. equity strategist and global head of ETF research over at Citi. And I know that a big part of the rally, Scott, that we've seen over the past 2 weeks has been a little bit more technical in nature. But I am curious if there is a fundamental case to be made for the continuation of this rally, in your view.
Oh, I think there definitely is a fundamental case. It's just going to take some time to play out. I think the chart that Scarlett just showed is sort of mission critical on this. So there is a fundamental element to this. Back, as we're coming off of Liberation Day and then on the heels of Moratorium Day after it, you were still looking at a circumstance where the earnings trajectory and fundamental profile for the S&P and broader U.S. equity markets was clearly in jeopardy as a function of materially higher tariffs. Now, we've walked back from that cliff, as you will, to something that's less onerous, but it's still not clear. A 10% effective tariff rate, just factoring that in as a baseline case, still creates a headwind for fundamentals for the S&P 500. And as you go into the ongoing budget negotiations, signs of economic slowing, as you're already pointing to, I think we have to allow that there's an opportunity for the S&P to digest some of the recent gains.
I am curious, though, too. I mean, it's curious that you bring up the tax bill, because I know a lot of folks in Congress, on Wall Street, have been waiting to see a little bit more progress when it comes to some of these fiscal proposals, whether it's dealing with the budget deficit or these tax cuts, et cetera. If we do get a little bit more clarity on that and Congress is able to move this forward, and presuming that the tariff trade war doesn't heat back up to the extremes that it was just a few weeks ago, is that going to be enough to sort of placate investors in the meantime, or are they still, do you think, maybe going to be sitting on the sidelines?
I think the storyline very quickly, even though we're mid-May, the storyline is going to quickly move to how much of an earnings snapback can you get in 2026. Now, right now, we're projecting earnings growth for next year somewhere in the low teens, 13, 14%, not too far off of where consensus goes. So the discussion point around all of this is that we've been to the precipice on tariffs. We've walked back. We're still navigating where we go with the budget process and where that takes the deficit math. But all told, what the opportunity for equities here is that as you turn the mid-year corner, begin to go through the back half, eyes usually pivot to the out year, right? And so if we're able to look at a fundamental and economic valley right now that leads to growth coming out the other side, yes, that's where you get more constructive on U.S. equities. That's what's more or less reflected in our bull case, not our base case, but a bit premature to go down that path just yet.
Okay, if that's what you believe, that you could get more constructive in the second half, where do you park your money in the meantime until we get evidence that that second half recovery will start to materialize?
Yeah, so going into Q2, we went down the growth is defensive path, went overweight tech, married it with an overweight in communication services. And then on the heels of the Liberation Day and then Moratorium Day levels, we came in and said, look at from these points, we want to be a buyer of U.S. equities. We want to focus on growth. And the whole angle here was that the fundamentals for the mega cap growth part of the market remained pretty intact. Valuations had corrected pretty significantly as that part of the market drew down the most to your oversold indicators that you were looking at earlier, Scarlett. And so what the setup was, in our view, and still is for that matter, is that we've got the best visibility of persistence of growth in that part of the market. We've alleviated some of the shorter-term concerns. Yes, we've gotten aggressively priced, probably on a very short-term basis, but we still think fundamentally this is the best place to be. Now, for context, that growth part of the market came through Q1 earnings with essentially no change in 2025 estimates. The same cannot be said for the cyclical and defensive parts of the market, where we're still probing for an earnings expectation bottom for 2025.
Okay, so growth is back to being a defensive play, and I guess Mag 7 as well, although the two are often the same thing. Which kinds of growth companies are the most all-weather, given that there's still so much up in the air right now?
So all-weather probably is best defined by the software component. That part of the market is probably less exposed to tariffs on a first-order effect. Maybe you get caught up in second-order, broader macro concerns. But I would say the software side, the internet and media space right behind it, probably in that pole position on that. Now, where it gets interesting is as you back off on some of the China angst, semiconductors come back into play. And we've been overweight semis going into this year. And there you had the more significant valuation setback into the, let's call it the tariff and Liberation Day, post-Liberation Day lows. So you have more snapback opportunities still. Now, that's playing out pretty quickly, but I do think that play is there. And then the last part of this is switching over to consumer discretionary. Consumer discretionary has been sort of front and center of where tariff impacts are going to show up most directly and most aggressively. So as you begin to peel back the worst case for tariffs, you come back to that sector. And then you've got names like Amazon, which have been caught up in that sell-off that presumably have room back the other side.
I'm curious, too, Scott, when we talk about the complexion of this rally that we've seen, this idea that so much of the buying has been driven by retail investors, at least if you believe some of the proprietary data coming out of various banks here. We talk about 22 straight weeks where we have seen individual investors as net buyers. Meanwhile, you've had something like, 16 of the past 22 weeks. We've seen the institutional side be net sellers. What brings the institutions back into this market?
I think it's the price action is what begins to bring you back. And then we caught this in our ETF flow work, Romaine, where we've seen over the past couple of months the flows into your broader U.S. into index ETFs has been very persistent. And that's where the financial advisor retail community kind of lives. Now, the institutional world, whether it's long only or long short, is living in a much more real-time performance backdrop where I think they've been, kind of caught into the tariff discussion. So I think what we're looking at right now is on the heels of moratorium day and then this most recent news on the China push out is that you're now snapping back into this risk-on mode that's causing some short covering, some repositioning, all of which has spurred the index up to where we are currently to these shorter-term overbought levels. So I don't discount any of this. This is all important in terms of where we are in sort of the risk backdrop. But I'd say all told, you're starting to see that money come back. But what it's going to need is more fundamental confirmation to keep it persistent. That's a missing link right now.
All right, Scott, always appreciate you taking time for us. Scott Kroner, U.S. equity strategist and global head of ETF research over at Citi on this Thursday afternoon with the S&P holding in the green, the NASDAQ flipping back into the red, and a big conversation coming up in just a second with the chairman of PGIM, David Hunt, speculating, or I should say reflecting, on a 14-year career as head of PGIM and giving us his insights here on the recent pause in investments and the need for more clarity and a tamp down in volatility to bring more folks back into this market.
Plus, there is still hope. Morgan Stanley's chief economic strategist believes that even with this fog of uncertainty, there's still a window for the Fed to cut rates this year. Ellen Zentner, the one and only, joins us with her outlook.
And all eyes on emerging markets. Scurrylock President Hans Hume's going to be joining us to talk about how tariffs and geopolitics are hitting the world of developing markets. All that and more coming up in just a second, right here on The Close. This is Bloomberg.
Exhausted investors digesting the latest tariff talk out of Washington.
prepare.
Next week, Bloomberg brings you live coverage from the Qatar Economic Forum. Bloomberg Horizons Middle East and Africa and The Pulse will be broadcasting live from the conference floor. Then, throughout the day, we'll bring you all the highlights from the key policymakers and market movers on the issues confronting the global economy. Live coverage from the 5th edition of the Qatar Economic Forum starts Monday, right here on Bloomberg Television. Context changes everything.
Volatility has come way down this month, but the big swings we saw in prices last month continue to haunt investors and executives alike. PGIM Chairman David Hunt, who just stepped down as president and CEO of the asset management firm, says clients are looking for clarity and they are very much in a, quote, pause period. Here's part of our conversation from earlier today.
I will say that the tone is absolutely more guarded, more difficult, and many clients are really putting allocations that they had planned on pause for the moment until there's more clarity. So we, came into the year where there was quite a lot of optimism, I would say. People really felt that U.S. exceptionalism was carrying on. They felt pretty good about the economy. The proportion of people who felt we were headed for a recession had fallen a lot. And what a shift in just a couple of months, and particularly in that first 10 days of April. So I would characterize our clients as they're pausing. They want to wait and see. They aren't taking action, so we don't see people selling. But they are not carrying on with the overweight they had in the U.S. The way that they were even 4 months ago. And they have absolutely paused on some of the risk assets that were coming back, like real estate. So we're in a pause period.
A pause period. What gets us out of that pause? Is this really just all about a tamp down in trade tensions, or is there more to it?
No, there's more to it than that. I think that people are all of a sudden fundamentally reassessing the allocations that they've had. So our clients over the last couple of years have had an over-allocation to the U.S., and they were nervous about it, but ultimately didn't see what a viable alternative was, and so kind of got themselves comfortable with it. I think they are rethinking that. They are thinking maybe we go back to our long-term averages. There's still, many of them are 5-8% above where they were. And maybe actually they want to go back to that, which will largely be done by new allocations, I think, rather than selling existing. But you are seeing people think it's not just tariffs. We don't really know what tax policy will be here and what actually fundamentally does get through the administration. So there's a lot of unknowns that I think people feel that just uncertainty is at a much higher level. The risk premium is higher, and therefore they're going to demand a higher return.
So animal spirits have certainly been muted.
Yeah.
Talk about the long-term changes that your industry has faced as you close out your tenure at PGIM. I mean, what have you put in place to position PGIM for the gold rush that we're seeing into private assets, especially at the retail level and at the wealth management level?
Sure. So I think that the biggest change over the decade has been that the world used to be divided into two. There was the kind of long-only managers that did stocks and bonds, and then there was the private equity guys who did privates, and increasingly they expanded beyond kind of private equity into private credit and into real estate. Those are coming together. There really is not two distinct ecosystems. There's not two distinct groups of clients that just want to talk about privates, publics. It's all coming together. And I think what I have tried to do at PGIM is actually to dramatically build out our private alternatives capability, because I really saw the fact that these were coming together. Our clients want to deal with large global players who offer privates and publics together and can create solutions out of it.
Part of our conversation that we had with PGIM Chairman David Hunt, of course, just stepping down as a CEO of the asset management firm at the start of this month, Scarlett. And it was kind of interesting to kind of bookend his career, because I'm told that the very first interview that you did with him was back 11 years ago, right?
Yeah, that's right. It was when we went to Milken, I believe, and it was his first big TV interview. So I guess he wanted to bring it full circle.
Yeah. All right. Well, cool. It was very nice, and I was just a wonderful man, and of course we'll keep tabs on where he goes next. When we come back, we're going to refocus
no golf,
on. I know that kind of annoyed me. Though. He said he's a tennis guy. Anyway, we're going to focus a little bit more on what's been going on in the world of public equities, and that includes Walmart. The share is down fractionally on the day. A pretty decent quarter, and that was largely because they cut prices on a lot of their products. But the CEO had a warning about where those prices might go next. That's coming up right here on The Close on Bloomberg. All right, let's get a view from the sell side. Our top calls, big movers on the back of analyst recommendations. And we start off today with Pinterest. Wolf Research raising its recommendation to outperform on improving fundamentals for the social media company's performance ads business. The analyst also sees the macro overhang easing with that temporary U.S.-China trade truce. Shares of Pinterest, though, down about 2% here on the day. Next up, Cisco. Wells Fargo upgrading to overweight after yesterday's earnings results beat expectations. Wells cites Cisco's orders at 3 of the 6 largest hyperscalers and growing by triple digits, and says accelerating AI momentum should continue to drive the stock higher. Those shares actually having their best day since April 9th. And finally, let's take a look at Dick's Sporting Goods. TD Cowen cutting to hold and panning the retailer's decision to buy Foot Locker for $2.4 billion. He calls the deal a strategic mistake, saying there is little to no precedence of M&A at scale creating value for shareholders within the softline retail space. Those shares down for a third day, in fact, having, I believe, their worst day going back to middle of 2023. Those are some of our top calls, and we do want to stay in the retail space and take a closer look at Walmart. The world's largest retailer reported strong sales and earnings growth this morning, but did caution that tariffs are increasing its costs, and, well, they may have to pass that on to the consumer. David Bellinger joins us right now. He's director and senior analyst of Hardlines, Broadlines over at Mizuho, and he's got an outperform rating on the stock. All right, let's start with the quarter that just was, David, because in that quarter, they also talked about how some of the transaction volume was actually aided by them cutting prices in the most recent quarter.
Yeah, look, we thought this was a good print. So Q1, you had same-store sales up 4.5% in the U.S. That's X the impact from gasoline. But you actually had each month of the quarter improved sequentially. They exited April on a good run rate. I thought they had some good commentary on the start to May. You actually saw some benefit here as it seemed like their internal sentiment readings got a little bit better. And there's not necessarily a pull forward here. Some of the categories that got better late in the quarter included food. That's not necessarily something you buy because a tariff is going up.
Right.
And those products are essentially domestic source, but we thought Q1 was good. Some of this limited near-term visibility, we think that's what weighed on shares earlier this morning.
And of course, there was also the comments from the CFO that they are preparing for price increases as early as this month. Won't that be confusing to Walmart customers, consumers in general, if they cut prices in the lead up to tariffs and then now they're looking to raise prices?
So I don't think so. So that if you step back here, you think about this, how could prices not go up, right? You had 145% China tariff. It's good that it's down to 30, but it's still a big number for Walmart and their vendors to digest here. So we're going to see Walmart raise prices just like everyone across retail, but they do have the optionality to not do it as quickly. So things like food, they're trying to keep as low as they can, as long as they can. They even mentioned investing in some prices and cutting, and there you could see a lot of volume gains to Walmart. They've had this Walmart Plus business for over a year now. They've got what we think about 20 million customers within that program, a lot of upper income homes who are ordering items online. We think that's very sticky. But Walmart here, they have these other highly accretive alternative businesses. They call it their second P&L. That's very unique to them. And we think that they could use that as a way to fund some of these price investments. And you should see the volumes pick up nicely.
Real quickly, David, do you anticipate, though, that we could see a bit of, I guess, a price war, if you will? I mean, I know Walmart's the only one that's really articulated right now where they might go on pricing. But at some point, we've got to hear from the other retailers next week and beyond as to maybe what they're seeing as well.
Yeah, I'd say maybe. But a lot of these companies are very much wired to protect their margin structure, right? So if you need to raise prices, you will. It depends on what you're raising them on, though. So some of these big ticket discretionary items, tougher to do, but you could sort of put this peanut butter spread across the business, raise other items where you can.
All right, David Bellinger, Director and Senior Analyst of Hardlines, Broadlines, and Consumer Internet at Mizuho. Thank you so much. There is a breaking news headline here. This is from the Wall Street Journal. Meta will be delaying the rollout of its flagship AI model called Behemoth. You can see there the stock now down 2.8%. When the headline crossed, Meta shares definitely extended their losses and have deepened their decline. This raises all kinds of questions, Romain, about the direction of all the AI investments it's made so far.
Yeah, this is going to raise some new questions. Remember, they were supposed to roll this out at the start of last month, and they kind of put it off. And now, at least based on the journal's reporting, it does appear that it might be a little bit further off. And it raises a question like, where does AI stand in this? But should we read into now maybe what some of these other companies have been developing and whether we can count on those actually coming out on the previously anticipated schedule?
Absolutely. And of course, the Mag 7 was already down in today's trading, but this extends their weakness. NVIDIA also extending its losses now down about 1.1%. Speaking of the company that's kind of at the center of the AI build out right now.
Yeah. And of course, dragging down now the NASDAQ down only about 0.6%. The NASDAQ 100 down 0.3%. But material change in direction and sentiment right now based on Meta.
All right. We'll continue to keep an eye on those shares. In the meantime, coming up, we're going to be speaking with Ellen Zentner. She is Chief Economic Strategist at Morgan Stanley Wealth Management about the Fed's inflation fight and how tariffs may be delaying those efforts. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic alongside Scarlett Fu. Shares of Meta taking a big leg down over the last few minutes, down as much as 3%. This after a Wall Street Journal story that says that the company is delaying the rollout of its flagship AI model called Behemoth. Remember, Meta had been touting this, saying that it actually could outperform some of the products being offered by OpenAI, Google, and Anthropic. Mandeep Singh covers this for us at Bloomberg Intelligence. A surprise?
Well, so we know Meta had issues with the Llama 4 release, and the fact that they didn't release a smaller model and the Behemoth model was released first did raise questions. In this case, I think I'm not surprised because Meta was an open source model that everyone should have adopted. Even before DeepSeek, Meta had that advantage. And suddenly after DeepSeek, everyone kind of moved towards DeepSeek as the open source choice. Yeah. So clearly their model wasn't performing as well as the other options, and the open source advantage was slipping away from them. At the same time, they did raise the capex when they reported the results. So that was a surprise to everyone. Like, why are they raising their capex? Well, even though they raised the capex, it didn't really translate into better model performance, and now they are really going back to the drawing board in terms of who can revamp the model to make it equal to OpenAI and the leading large language models.
Right. The Wall Street Journal says Behemoth was initially slated to be released in April, and now it's been delayed to the fall or even later. And in fact, Meta is thinking about making management changes to the AI product group. Is spending more money on this, hiring better talent, new talent, going to solve this problem?
Well, they have the biggest surface area for deploying these chatbots. If you think about, the family of apps, Blue app, Instagram, WhatsApp, they have the engagement. They have the surface area to monetize the engagement using chatbots. It's just they don't have their own model. Maybe a partnership with a Claude or one of these models may serve them better because they have the compute, they have the application, they just don't have the most performing model. And in this case, that's what they're trying to fix here.
All right, Mandeep Singh, really appreciate it. Mandeep Singh, of course, with Bloomberg Intelligence, giving us the instant analysis on news that Meta will delay the rollout of its flagship AI model, Behemoth, at least according to Wall Street Journal reporting. All right, let's shift from Meta to monetary policy, because Fed Chair Jay Powell earlier today had this to say about the Fed's average inflation targeting.
In our discussions so far, participants have indicated that they thought it would be appropriate to reconsider the language around shortfalls. And at our meeting last week, we had a similar take on average inflation targeting.
For more on monetary policy and the economy at large, let's bring in Ellen Zentner, Chief Economic Strategist at Morgan Stanley Wealth Management. So the Fed is reconsidering, and is reconsidering a lot of things right now because so much is in flux. What we know is that it's not going to do anything at the moment, even as people speculate there might be a more dovish Fed because of today's data dump. What is your take on the data that we got today, showing that retail sales were kind of muted, wholesale inflation actually cooler than anticipated? What's the takeaway?
Well, so I think, retail sales were muted because this is the April data that we just got. We know that there was some front loading ahead of the expectation that tariffs would hit prices. I think there's more front loading to come that's going on this month. So I think when we get retail sales next month also, we'll probably see a little bit of that front loading continue. But really, in terms of the inflation data, this is the month that it's hitting. So when we got CPI and PPI this week, that's April data. So you can kind of say, well, that's great. Before the tariffs hit, we were in a disinflationary trend. Unfortunately, we know what's coming. And I think what's so interesting to me is markets breathe this big sigh of relief that tariffs on China are not going to be 145%. They're going to be only 45%. But at the end of the day, that is double what they were in January. When you look at it on a trade-weighted effective rate, it was 20% in January. It's 40% now. That is double. That's significant. And so I think we're going to be back to markets are pricing in all the good things and none of the bad. The bad has not shown up in the data yet, but it is coming.
It is coming. At what point does it come? Because at the wholesale level, and you're going to see it first before then it trickles down to the consumer level.
So I think you're going to see, let's say when we get into the next earnings season or even in the late summer before that, when companies are really trying to posture we didn't see as sort of dire forward guidance as you would have expected in the first quarter. And I think probably because tariffs were so uncertain, I think you knew that some margin squeeze was going to come. But do you want to really guide toward that when you're not really sure what the outcome might be? Well, now they're on a footing where you could end up disappointing. And so you've got to do some sort of pre-guidance before the forward guidance in the earnings season. So, these companies that don't have a lot of pricing power are going to feel it on the margin. And I think investors will sniff that out before we get to the next earnings season.
I'm going to ask you a really dumb question because when I was reading the PPI report today and they kind of made this, you read in between the lines, you could kind of see that there was this issue that a lot of these companies apparently might actually be taking that price right now. And as we heard from Walmart, they may not do that for long. Is it better? What is the impact on broader economic data points? So like GDP, retail sales and things like that. With the price action or the price pressures are on the wholesale side and being absorbed by the company or passed on to the consumer, or does it not matter?
Well, so tariffs always fall here, there, and everywhere. Yeah. So there's going to be some that the producers absorb, some that will have to be absorbed on the margin, and some that are going to be absorbed by the consumer. So what you end up seeing is, to the extent margins are getting hit, you're going to see it in valuations, you're going to see it in business investment because they have to pull back. Now, they also then have to pare costs, and so you probably then see it somewhat in higher layoffs. And then at the consumer side, consumers are we're not indiscriminate buyers anymore. So they're not going to just demand the same exact amount, even though prices increase. And so businesses are going to also feel it on their bottom line.
So another side of this whole economic, trying to read the tea leaves on it, is this idea of kind of where we go in the labor market, where we go with regards to productivity. We were just talking about AI with Meta. I mean, that in theory, long term is supposed to be maybe additive to productivity here. I am curious if you see that coming soon, that could actually be a tailwind for the economy and for the labor market.
Well, so it absolutely can be a tailwind with driving productivity. We've got great productivity numbers right now. And I'm going to echo what some of the other sort of economists, academics are saying, in that what we're seeing right now is normal in a business cycle, that we've gone through a long period of very tight labor markets. Businesses seek efficiencies, and as they deploy those efficiencies, it drives productivity gains. And that's just a normal cyclical feature. However, I am very optimistic about AI and what it can provide in terms of a tailwind to the economy and to productivity. And I think it's very important that we are in a two-horse race with China on AI. I think it's very important that we limited the H20 chips from NVIDIA to China or countries friendly with China, because it still keeps us ahead in that two-horse race. Probably a little bit, if I think further out on the horizon, China is going to be able to scale better than us when the technology tops out. But we are still developing faster. And I do think that the sky is the limit when we think about what all productivity gains it can provide. There are ethical issues. These are, very scary things that we can do with AI, but there are probably some very beautiful things too. And I think that some of the uncomfortableness is probably just natural in a technological revolution. But what does that mean? Probably within the next year or two, we start to see more and more of those productivity gains that we can point to and say, aha, that's AI.
You talk about China and U.S. being in this two-horse race when it comes to AI. But this week, we've seen a lot of deals announced in the Middle East with the president making his big trip through the region, and especially when it comes to U.S. companies providing hardware to companies in the Middle East, in Saudi Arabia, for instance. What does that mean for that region's development of AI and how that looks geopolitically?
Yes, I think the Middle East is very interesting and maybe gets another horse into the race, and a horse that importantly is friendly with the U.S. So the Middle East knows that they need to diversify and diversify away from oil, and they've got the capital to do it. And so you've also got tremendous upside for data center potential. And now you've got partnerships with the U.S. to get the chips that you need. And so I think that can quickly ramp up. And so I think that it's important that as we see more horses enter the race, that they are countries that are friendly with the U.S. And staying friendly with the U.S. means you probably will get the high-speed chips that you need. I also think in that regard, the U.K. could be interesting. We saw that with DeepMind, the government was helpful in Google developing DeepMind there. And so I think the U.K. could be another interesting horse in the race.
Are there some of these relationships or partnerships, whatever you want to call them, is that enough to sort of fill whatever hole is left by China not being sort of in the party?
Well, we hope.
Yeah.
I think that there's room for more. I don't think there has to be just one or two big players in AI. I think there can be large partnerships in how we harness AI. I think there's also a lot more on the regulatory front that needs to be done on sort of the ethical side of this as well. But I think, as is typical, the technology is progressing at lightning speed, and regulation and policymakers are not going to be able to keep up with it. But in a sense, that's the only way you can win this race. I had the absolute pleasure of talking to Secretary of State Condoleezza Rice back in December, and she's been touting the run, don't walk toward AI. And the way we've stayed ahead in this race, say, versus Europe, is that we're adopting now and regulating later, whereas Europe is regulating first and adopting later. And you're not going to win that race that way. But it also means that we are moving at the speed of light, and then policymakers are going to have to catch up.
All right, Ellen, always appreciate you coming on.
Thank you.
Ellen Zentner, Chief Economic Strategist at Morgan Stanley Wealth Management. And, of course, another leg of this whole stool when it comes to the president's policies, of course, has to do with trying to bring more manufacturing back to the U.S. An interesting comment by the president during his trip in the Middle East, saying that he asked the CEO of Apple, Tim Cook, to stop building plants in India to make the iPhone. Joining us right now is Mark Gurman, who covers all things Apple for us. And Mark, kind of break this all down. I mean, it's been very public that Apple has been looking to diversify its supply chain. It has struck deals with manufacturers in India. And now you have the president basically saying, don't do that. Where's Apple going to make iPhones if they can't do it in China and they can't do it in India?
Well, just because Donald Trump says you can't make iPhones in China and you can't make iPhones in India doesn't mean that Apple's not going to make iPhones in China and iPhones in India, right? He doesn't have that kind of power. Obviously, the tariffs are something that are going to impact where Apple's going to produce its devices. But if he wants to hit Apple, he can't just put a tariff on Apple, right? But he can hurt them in certain respects. But there's no solution here, right? It's going to either be India or it's going to be China. Maybe it could be some other Southeast Asian countries, places like Malaysia, Thailand, Vietnam,
but how fast,
where it's not going.
But Mark, how fast can they even shift? I mean, they've been sort of doing this India thing for a long time now. You're talking about 20% of their production in terms of devices is now coming out of India?
But there is no shift. Okay. It's China to India. There's no additional shift. There's no moving again, right? These phones are being produced in China and India, maybe other parts of Asia. These phones are not going to be produced in the U.S. There's no magic lever or magic genie in a bottle that can get this to happen. It's just not feasible from an engineering standpoint, from a cost standpoint, from the resources that it would need to move, to build up contract manufacturing, to build up engineering education in the U.S. It's just there is no shift. It's India, which is already happening, China, maybe other parts of Asia.
So we know that Apple assembled about $22 billion worth of iPhones in India in the 12 months through March, and that's a pretty big leap over the same time a year ago. What's been the cost of doing that, of moving some of that production to a country like India?
Well, they've spent billions on new partnerships, new manufacturing facilities, new places to actually develop the products. That has been an expensive endeavor. It's also been expensive because you're putting resources towards needing to build new manufacturing facilities and re-engineering the devices to be built elsewhere. And that's time that could have maybe been better spent building the device, building new versions of the devices or innovative new features. So certainly this has all had a cost on people, monetarily, and on future products.
So you've made clear that the iPhone, moving the iPhone and the manufacturing of that device to the U.S. is an impossibility given the resources we have on the ground here in terms of human resources, the talent, the skill set, the capacities, the facilities. What about other products? Apple does make some iMacs, I believe, in the U.S. I mean, could it fulfill some of President Trump's requests by boosting its manufacturing of other devices here?
That's exactly what I expect Apple to do, is start producing something else, maybe some accessory, maybe device packaging, lower level, easier types of things. You could make a couple of the additional Macs, maybe a Mac Mini in the U.S. You can maybe make certain types of iPads in the U.S. So what you'll see is they'll probably make an announcement sometime in the next few months that they're going to start producing some Mac desktop, some iPad, some additional chips, some iPhone components, some iPhone packaging in the U.S., right? But in terms of this thing right here, it's not happening.
All right, Mark Gurman, thank you so much. Bloomberg's Mark Gurman, who covers all things Apple for us here at Bloomberg News. And Romain, there was a Bank of America report that said that if Apple were to make the iPhone in the U.S., it'd be upwards of $3,000 per device.
Yeah, I mean, financially, there's just no way that's going to happen anytime soon. But it just also gets to this idea, too, that, you just can't shift supply chains around as quickly as maybe the president wants them to, as Mark pointed out. So.
Absolutely. All right, coming up, Kuei Wen of Research Affiliates will help us count you down to the closing bells as we look at an S&P 500 that is up by 0.25%. From New York, this is Bloomberg.
Consumer discretionary has been sort of front and center of where tariff impacts are going to show up most directly and most aggressively. So as you begin to peel back the worst case for tariffs, you come back to that sector, and then you've got names like Amazon, which have been caught up in that sell-off that presumably have room back the other side.
Scott Cronin over at Citi kicking us off to the close just about 50 minutes ago. And, of course, the big sell-off that we had back in April is providing, I guess, some degree of opportunity if you are looking for an entry point and, I guess, if you have some confidence about where economic and fundamental conditions go next.
Well, that's a really good point. Is it confidence when everyone is bidding up classically defensive sectors like the telecoms, food and beverage, tobacco stocks, and household and personal products? Because those are the groups within the S&P 500 that are up by at least 2.5% right now. And the S&P 500 itself only up by 0.4% because big tech is under pressure. But what does it say when everyone's going in, flocking to those defensive stocks?
So you're saying I shouldn't be celebrating the fact that, Steris is the number one best performing stock in the S&P? Or American Waterworks is number 4. But, there's something for everybody out there, Scarlett. Not everybody wants the sizzle of the Metas and the Apples of the world. Maybe there is life out there beyond big tech. Kuei Wen is a partner and CIO of Equity Strategies at Research Affiliates, and she's devoted her career to looking for those opportunities, and great to have you here.
Thank you.
I am curious about small caps. I mean, at least today we're seeing relative outperformance, but there was a stretch before some of the turmoil where we had saw some pretty consistent outperformance by some of the main indices that track small cap stocks. And I am curious as to where they fit in an environment where people are coming back looking for bargains, but at the same time, we're still kind of waiting for economic data to maybe ratify a lot of the fears we had about the impact of tariffs.
So one of the things about the stock market is that it prices in economic expectations before you actually see the numbers. What we saw was a big drop in the S&P due to uncertainty about tariffs, leading to uncertainty about the economy. What we're seeing now is that that's kind of over. Unless Trump regresses back to where he was before, which seems very unlikely, or does even worse than what he did before, which seems even more unlikely, really the expectations, or the worst of the expectations, are really behind us. So, I think that, are we going to get a recession later this year? Probably. But to some degree, the stock markets already know that.
Yeah, but when we saw a rebound in a lot of these stocks, and obviously, big tech sort of led that rebound, but it was also interesting to see all the tariff-exposed stocks also get a pretty strong bid. A lot of retailers, apparel makers, sneaker makers who have outsized exposure to the Chinese supply chain were bid back up. Now, they haven't gotten back to their pre-sort of Liberation Day levels, but they look like they could maybe potentially get there. Do you see an opportunity for that?
Sure. I mean, I definitely see opportunity for that. I mean, people aren't necessarily going to stop buying things. They may shift their consumption basket. They may buy less of one thing and more of the other. But ultimately, the consumer data that's come out in the U.S. has been relatively resilient. I mean, some of that is the front loading, but also you don't necessarily see employment falling off a cliff. I mean, yes, I do think that employment's going to slow, but at the same time, I think that there's a lot of retailers out there that are well positioned and that are cheaply priced.
And we'll be getting some of those results in the coming weeks to really get a sense of, how much pressure they feel at the moment. You mentioned how, the president could kind of turn things on a dime. It's been made clear that there is a Trump put. Is it in the bond market or is it in the stock market right now?
I really think it's in both. I do think it is in both. Now, I think the strike may be a little bit lower than some people would like, but I do think that it really is in both.
So in the bond market, where do you think the strike is at? Where do you think it's at in the stock market?
So I think that Trump is not necessarily against having yields be high as long as the growth justifies it. I think what he was particularly annoyed by is just the disorderly nature of how the bond market behaved, right? So when people were expecting there to be a recession, you saw bond yields spike, right? Basically saying there's a lack of confidence in the United States as a sovereign. So I think that's really where it comes in. I think that what he really is looking for is not necessarily a ceiling on yields, but really a ceiling on yields relative to the outlook for the economy.
And also, I think to a certain extent, maybe relative to the value of the dollar as well, which seems to be a big component that they're also trying to address. So how do you sort of model that in, or do you not? Do you just wait until, we actually see a real result?
So I don't think I don't think that there's a lot that's changed in the immediate present of the dollar and U.S. bonds. The U.S. dollar is still the reserve currency of choice. Now, has what happened undermined that position? Probably, but since there aren't really a lot of other options out there, the move out of the dollar or the de-dollarization that could happen is going to happen probably very, very gradually. So, in that sense, long term, yes, there should be a higher risk premium on all U.S. assets, including the mega cap stocks, right? And so for us, that's why Is
that premium there, though? I mean, I think I see a little bit in equities, certainly not in fixed income. Or long term, or at least long duration.
Long duration, it's not, because, again, there's really no alternative, right? But going out 5 years, 10 years from now, I think there will be a gentle de-dollarization.
So, Quay, Scott Pronert was on earlier from Citi, and he was saying growth stocks are now your defensive play at the moment. I know you've been looking at small caps because of the incredible value, the opportunity that they provide. Within growth, is there value still there?
Within certain areas of growth, there's still value there. I mean, I think that one of the things that you see, for example, is you look at the Mag 7, right, and you have Alphabet. It's trading at 17 times. It's a discount to what the S&P is trading at overall. Apple, it was trading at 40 times last year. It's now trading at 30 times earnings, right? Partly because prices, the stock price has stagnated, but earnings continue to grow. So I do think that you do find some value or increasing value there, opening up opportunities. I wouldn't necessarily rule out investing in some of these growth stocks or some of these technology stocks. But at the same time, I think there's a lot of other very, very attractive opportunities outside the mega caps.
All right.
All right, Koi. Always great to talk to you. Koi Wynn, partner and CIO of Equity Strategies at Research Affiliates, helping us count you down to the closing bells. Just about 2.5 minutes to go. And Scarlett, stocks continue to oscillate between gains and losses. The Dow and the S&P holding in the green, the NASDAQ in the red, dragged down partly by that drop that we saw in Meta.
Yeah, absolutely. And that was news that just came out in the last hour or so that Meta is delaying the rollout of its AI behemoth model. And of course, that raises all kinds of questions about what it means for the rest of the AI ecosystem and where they stand. We have seen stocks move from being oversold to overbought awfully quickly, and it's a matter of figuring out where we're at. Yeah,
our RSI, though, on pause right now as we move closer to the closing bells. A full breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, taking you through to the closing bell with a global simulcast that starts right now. Tim Senovic in the radio booth, Emily Grafeo in today for Carol Massar, Alex Steele on assignment as we welcome our audiences across all of our Bloomberg platforms, television, radio, and our partnership with YouTube. Tim Senovic, an attempt here. Oh, wow, I looked awful in that picture. Tim Senovic, what do you make of this mini rally, if you will?
I guess. I don't know. In the context of what's happened since April 8th, it's kind of not much, but it's pretty remarkable to see the rise in equities just in the last 5 weeks or so from those lows because, what, Emily, we're up 20% since then?
Yeah, about 20% since the April 8th low, which is just incredible here, really the strength of the rally. So maybe all of the fears about an upcoming trade war are just not on investors' minds anymore.
Well, 25% if you're talking about the NASDAQ 100 since that April 8th low, which just gives you a sense of how quickly things can shift. The question now is what happens next and which headline we would be looking at in terms of whether it's going to be earnings or some kind of tariff update that could give us the next leg up.
Well, that's what I'm curious as to what the next catalyst would be. I mean, we've kind of gone through the meat of earnings season. I know we get a few retailers next week that might shed some light on the tariff situation. But beyond that, we're in that sort of zone where it's going to be maybe much more driven once again by Washington and maybe not by the White House. I mean, remember, Congress is finally getting around to addressing some of the other fiscal proposals that the president had on the campaign trail. We'll see if they can make it through the gauntlet in Washington. Meanwhile, here on Wall Street, we do get the closing bells, and we do have green on the screen for most of the major indices, including a 0.7% gain for the Dow Jones Industrial Average, up about almost 300 points on the day. The S&P higher by about 25 points, going to close above that 5,900 level, a gain of about 0.4%. The NASDAQ 100 is going to finish the day in the green, only about 0.1%. We should point out the RSI, basically the relative strength indicator that, I guess, determines overbought or oversold conditions. That remains in overbought territory. The NASDAQ composite, though, is down 0.2% on the day. And your outperformer on a relative basis comes from two different areas. One, the Russell 2000 up 0.5%, and the other, the S&P 500 Equal Weight Index, which is up 0.9%.
Okay, look at that. In the S&P 500 non-equal weight index, 375 stocks did move higher. We did see 128 stocks move lower, though. I guess it would be the same in the equal weight index, too, Romaine.
I don't know. Is that true?
The number of decliners and advancers, yes, that's the same.
Yes. Yeah.
Whether it's just non-equal weight or
just doing some quick calculations in my head, it would be the same.
It would be the same. You're right. All right, let's take a look at what happens when you look at it on a sector-by-sector basis.
Now I'm kind of doubting that. I don't know why.
Because I said it.
Because I know it's. Go ahead.
Well, it's because the equal weight index is higher than the market cap weighted index, that this IMAP looks kind of lopsided, right? Because you have tech, communication services, and consumer discretionary. These are the three sectors that encompass megatech. They are the only sectors in the red, but you could see that they take up fully half of the pie. Utilities, consumer staples, real estate investment trusts doing the best, all up at least 1.8%. These are all dividend-paying stocks that are classically defensive, so it tells you where investors' heads are, at least for today.
Hey, before we get to the gainers and decliners, we are getting some earnings. Speaking of tech, Applied Materials, of course, in the semiconductor space, saying that net sales in the most recent quarter did come in a little bit light, roughly about $7.1 billion. The street was just looking for just a few million more than that. So a modest miss on that front. And on adjusted EPS, they did beat $2.39 a share. The street was looking for $2.31 a share. And the company says that for the fiscal third quarter, so basically the guidance for the fiscal third quarter, they do see net sales in a range, a pretty wide range of 6.7 to 7.7 billion. The street on average, Tim, was looking for 7.2 billion.
Okay, there you have Applied Materials down about 1.9%. A reminder, we're still expecting results from Take-Two, Virgin Galactic, Kava, and a few more as well. In the meantime, I do want to take a look at some of the gainers on my radar today. Got to start with Foot Locker having its best single day ever, 85.7% to the upside. This after we learned that Dick's Sporting Goods agreed to buy the company. It's a cash or stock deal. It implies an equity value of about $2.4 billion and an enterprise value of about $2.5 billion. But even though this is the best day ever and the stock surged 85%, it's really only at levels that were last seen just in December of 2024. The stock has gotten hammered really in recent years.
It's kind of interesting, too,
yeah.
to see some of the analyst notes on that. I mean, really just kind of slamming this deal. I mean, TD Cowen was basically just saying, I just don't get it. You know, $2.4 billion or whatever they're paying for Foot Locker in the softline retail space to scale up.
Look, Dana Telsey was on our program a little earlier from Telsey Advisors. She's really optimistic about this. She said, wait and see. She reminds everybody the way that Dick's Sporting Goods in recent years was able to really reinvent the way that it sold things in its stores and attract this demographic that isn't necessarily attracted to the Foot Locker stores. So like young men, 18 to 25, for example. She's pretty optimistic about this.
I set foot in the Dick's the other day, last Saturday, to get something for my wife, a T-shirt. I hadn't been in one in a long time. I have to say, they were insanely friendly in there. All of the people work. Yeah. I mean, because I didn't know what I was looking for, and they were really helpful. It was quite an experience.
Yeah,
I won't go back, but it was quite an experience.
Did your wife like the shirt?
She did. It was very great. So I'm doing my part here.
Okay, you are.
Nike shirt.
All right. Happy Mother's Day.
Look for that in the earnings. Yeah.
All right. Cisco. Let's look at what shares of Cisco did. They ended up rising on the day today. This after the company issued a solid forecast for revenue, up close to 5% today. Solid forecast for revenue for the current quarter. Sales expected to be $14.5 billion to $14.7 billion. The company, like many others that have reported in recent weeks, is benefiting from demand for systems using AI tech, corporations and cloud computing providers expanding their networks to handle the surge in AI software. We also got some news about a little executive shakeup at the company, including the departure of Scott Herren as the company's CFO. Once again, shares of Cisco up by more than 4.8%. And finally, back to retail, Birkenstock Holding, BIRK, shares up close to 6% today. The company raised its earnings forecast for the year due to strong sales of its high-end sandals, expecting adjusted earnings of $740 million to $750 million. Sales rose 18% on a constant currency basis. They saw growth in all regions, including Americas, Europe, Middle East and Africa, and Asia Pacific.
It is sandal season coming up, and so that makes sense why sales would be going up and people are bullish. I put a couple of things in my shopping cart not so long ago. So there you have it. Let's also look at Take-Two because those results just came out. And the ticker here is TTWO, and we are looking at the first quarter. Let's give you the numbers for the quarter that ended. Fourth quarter adjusted EPS was $1.08 compared with 28 cents a year earlier. Not sure we're comparing like with like here. But in terms of adjusted EBITDA for the period, $291.3 million does miss the average analyst estimate, which was just under $310 million. As for the outlook, it sees first quarter adjusted EPS of 20 cents to 30 cents, and it sees net bookings of anywhere from $1.25 billion to $1.3 billion. Analysts were looking for, on average, $1.27 billion. Right now, the stock is lower by about 5% in after-hours trading.
Okay, I'm watching what's going on with Virgin Galactic, ticker SPCE up 3% in the after hours. Some headlines crossing. Astronaut sales are expected to open up in the first quarter of next year. We also got results from the company. First quarter revenue beat estimates, did report a loss per share of $2.38 versus a loss per share last year of 25 cents. The company sees second quarter negative free cash flow from $105 million to $115 million. The estimate for the cash flow was a negative $106.1 million. Shares higher by about 3.6%. First quarter revenue coming in just above estimates at $500 million. Is that $500 million? Yeah, $500 million. Adjusted EBITDA loss of $72 million. The estimated loss was for $70.9 million. Excuse me, that's $500,000 for first quarter revenue. Excuse me.
Those shares higher right now, but let's look at some of the decliners today. United Health shares closed for the 8th straight day, closing lower, down 11%, but the stock did plunge as much as 19%, hitting the lowest level since April 2020 after the Wall Street Journal reported that the health insurer is under criminal investigation for possible Medicare fraud. The company said in a statement late yesterday that the DOJ hadn't notified the company about the reported investigation, and they said, quote, "We stand by the integrity of our Medicare Advantage program," but still a really rough string of days for that company. I'm also watching shares of Meta. That stock closed down 2.4% after the Wall Street Journal reported that the Facebook parent is delaying the rollout of its flagship AI intelligence model. It's called Behemoth, but we'll have to wait a little bit longer to see that full rollout. And finally, Coinbase shares closed down 7%. It was the worst day since March 28th, and this is just after it was announced that it was added to the S&P 500. It was up over 20% earlier this week, and yet this morning got hit with two pieces of news that really weighed on the shares. First, a hack over at the largest crypto exchange. Hackers had near constant access to some of Coinbase Global's most valuable customer data since January, according to Bloomberg reporting. And then additionally, the New York Times reported that the SEC has been investigating whether the company misstated its user numbers in past disclosures.
All right, and we should point out Bitcoin right now down fractionally on the day. So too is the dollar, and down in a big way are Treasury yields, roughly about 9 to 10 basis points across the curve as a lot of people now start to reprice in what they expect the Fed to do. That, of course, that was on the back of that slew of economic data that we got this morning. A real mixed bag here for economic conditions that at least has some investors thinking the Fed might actually act.
All right, we'll have to wait and see. Scarlett, you mentioned what's the next catalyst. Do not forget May 28th, NVIDIA earnings.
Yes.
Maybe that's the big one.
That's what, still another 2 weeks away.
Still another 2
weeks away. There's a lot of meandering between now and then.
I got to look forward to something, okay?
Sounds good.
Okay, that is going to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, and at Bloomberg Originals. We're going to be back tomorrow, same time, same place.
And our coverage continues here on Bloomberg Television, a closer look at global markets, specifically emerging markets. A conversation up ahead with Hans Humes, the CEO over at Greylock Capital. He's going to talk about the landscape as well as some of the deals, maybe, that did not actually happen today. That's coming up next, right here on The Close. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
All right, welcome back to The Close. Romain Bostic here with a wrap-up of how markets sit today. Fractional gains across the board for most of the major indices. The NASDAQ composite sitting this one out, down about 0.2%, but the S&P gaining about 0.4% here on the day. But it was very defensive in nature. You did not see a lot of those big cap tech names leading the charge. It was a lot of folks in the healthcare space, and as you can see there, in the utility space. In fact, the Philadelphia Utility Index up about 2% here on the day. And of course, you saw that big shift in yields. A lot of people looking at economic conditions and now making a bet here that maybe, just maybe, the Fed will indeed actually cut rates sometime soon. Some notable movers here in the after hours trade as earnings do cross the wire. Applied Materials, Take-Two Interactive, and Kava Group each down about 3% here on the day. Applied Materials reporting, of course, they are the largest maker of chip manufacturing equipment. Some of the guidance that it gave, a very broad guidance, I should point out here, as some of that uncertainty is there. A low end of that guidance, well below the average of street estimates. A similar story for what we saw with with Take-Two, and Kava Group, of course, the fast casual chain just crossing the wire right now. That company saying that in its fiscal first quarter, EBITDA did come in slightly above estimates, $44.9 million. The street was looking for $43.8, and revenue also coming in at a slight beat at about $332 million. The street looking for $326. We should point out the company is saying that for the full year, it does still see comp sales in the 6 to 8% range, so a ratification of its previous guidance that it had given the market. We want to turn now to our top story for the next hour, and that really is the bid into global markets and specifically into emerging markets assets. And a lot of questions out there as to whether that rotation is justified. So far, so good. Because through all the global turmoil this year, emerging markets have proven to be an unexpected winner. EM stocks as a group sitting on year-to-date gains of about 9%. An index of EM currencies has rallied 5%. And the risk premium on emerging market debt this week has been narrowing at the fastest pace since 2022. The head of PIMCO's EM debt business telling Bloomberg earlier today that investors are taking advantage of high yields and improved fundamentals to buy up local bonds in developing nations, which as an asset class are off to their best start to a year since 2017. The outlook, though, hinges on some sort of resolution to Trump's trade spat and, well, some semblance of a resolution to military conflicts, including Russia's war in Ukraine. Joining us now to break it all down for us is Hans Humes. He's a CIO at Greylock Capital, and he has made a living restructuring distressed debt from troubled nations, including Greece, Ukraine, Argentina, Venezuela, and I'm probably forgetting quite a few others. Great to see you, Hans. It's been a long time.
Yeah, it's been a long time. Thanks for having me.
It seems like the opportunity right now might actually be ripe in some of these markets, and I am curious if you're actually finding opportunities or value, I should say, out there.
Absolutely. I mean, I think the thing that people should take a look at is what Trump said in Saudi Arabia 2 days ago, and coming out and unilaterally lifting the sanctions on Syria. And the language he used with that points to potentially a complete game changer for EM. One, he identified sanctions as being ruinous. And then he had this additional comment about U.S. presidents have always made the mistake of utilizing U.S. policy because they've looked into the souls of foreign leaders. So, in effect, what he was saying is like, I'm about commerce, not chaos. And identifying the use of U.S. policy when we make a moral judgment is huge. Because the opportunities that exist in these countries when you strip out our point of view. Syria is a small case. You take a couple steps back and you look at Ukraine as a sort of proof of concept deal. I quickly took a look at 5 countries, just 5 countries. And if you give the U.S. first mover advantage in those countries, you're looking at commodity wealth of $90 trillion.
Wow. Do you think, though, he's going to be consistent on that? And I'm talking about across these various countries, or is this going to be just a country-by-country basis based on his own feeling about, who he thinks deserves a reprieve?
My feeling is he's got a particular point of view on how things should be managed, and it should be, basically a business-led. If we're going to have boots on the ground, there should be boots of guys dressed like you and me, not military. And he has come out clearly and said sanctions aren't the way to operate. So I think below it all, this is his mantra.
And he made that clear on the campaign trail, at least in general, about this idea that he does not want the U.S. to necessarily be the moral arbiter that I think we've tried to be for decades. I am curious, though, about this idea of rebuilding some of these nations, because you can remove sanctions, but we're also talking about countries that are devastated. Syria devastated, Ukraine devastated. Even when you look at countries like Venezuela, you're talking about Iraq. You're talking about a huge climb economically, and that's going to require a lot of investments. And obviously, that might benefit investors. But I am curious as to the risk in getting to, I guess, the promised land.
I mean, obviously, you're going to have risks in all these countries, and you have inevitable economic distortions that are created when you have sanctions. You start creating economic interest for getting around sanctions. But take a look at the raw numbers of mineral wealth you're dealing with. Venezuela, potential $30 billion. You've got Iraq with $20 billion. And the reconstruction in these cases, obviously different outcomes. I mean, I'd argue in Iraq, we have some responsibility for participating in it. But rather than putting sort of government money or development money in there, make the countries our partners and give U.S. companies first mover advantage. There's not one of the countries of the 5 that I chose that hasn't reached out to the U.S. or expressed an interest in having U.S. firms involved.
Do you think the U.S. government, though, will be at the forefront of that? And by that, I mean, in some of those nations, there is potentially competition coming from the world's second largest economy as they try to sort of influence the world in their own way as well. And I am curious as to how that's going to play out. Are these countries going to have to pick and choose one or the other, or is there sort of room for everybody in the pool?
You know, I went through a lot of discussions with Zambians when we did their debt restructuring, and you couldn't get a better example of the tension these countries feel. But I would say in general, countries prefer doing business with American companies. What we have allowed China to do, they're seeing this $90 trillion opportunity, and they've been looking at it for a long time, and they are allowing themselves access. We've kind of created barriers and put U.S. companies as a disadvantage. 2 days ago, that might have changed. And structurally, all we need the U.S. government to do is open the playing field and give us that first mover advantage to take advantage of the opportunities.
I want to go down to Argentina for a second because you've obviously had a big presence there for a long time. What do you make of it? I mean, Milei has, he came in, a lot of people thought he was crazy, but he's put in some policies that have certainly had a net benefit to the economy there. Are you pleased with the direction that government and its policies are having right now on the economy?
Yeah, and I think Milei's approach and what happened sort of behind the scenes in terms of giving him the room to push, his policies. It sort of gives a lot of credibility to the idea that go for the shock. And I think Milei as a person and the craziness that people say actually is part of why he's been able to do it. I mean, people like him. They're entertained by him. And I think that in general, I mean, we're not out of the woods with Argentina yet, but the numbers speak for themselves.
But is it like in a much better position than, I don't know, if we had this conversation even 5 years ago? I mean, you feel more encouraged now?
There were some structural problems that Argentina had to resolve for it to function. I mean, bloated bureaucracy. I mean, I'll give you the data points, but, province of Buenos Aires has the same level of debt that they did 10 years ago, and they have 2.5 times as many employees. They need to get the public sector down and revitalize the private sector. I mean, I can go into the weeds, but we probably don't have the time to do that.
All right. Well, we're going to bring you back, and maybe we can get into the weeds. I can talk to you all day. Hans Humes there is the CEO and CIO over at Greylock Capital. Thanks, Hans.
Thank you, man.
All right, coming up here, we're going to go down to Washington. The tax battle on Capitol Hill is underway. Courtney Rickert McCaffrey going to be joining us in just a second. Insights leader over at EY. This is The Close on Bloomberg. All right, let's go down to Washington, where a tax battle on Capitol Hill is playing out. House Speaker Mike Johnson reiterates that Republicans are close to reaching an agreement on the state and local tax deduction, but there are other big sticking points as well. At least 14 GOP lawmakers, at least for right now, saying they're not willing to sign off on this. Courtney Rickert McCaffrey joins us right now, Global Geostrategy Insights Leader at EY. And Courtney, I want to start off first domestically in terms of what's going on down in Washington, because when we talk about the president's trade policies, it was always promised that this was part of a much more holistic approach. The idea that we would get tax cuts, we would get budget and fiscal measures that would maybe blunt the impact of maybe what we're seeing with tariffs. When you look at the state of the tax bill, when you look at maybe whatever progress is being made on other budgetary issues, do you think we're going to get there?
Well, that's the $1 trillion question, right? I think tax bills, any big bill in Washington, and tax bills in particular, are always messy. There's a variety of different interests at play, different priorities, even within the Republican Party, of course. And so, nobody expected this to be sort of an easy or quick process. So I think they've moved very quickly this week. In fact, there's been a lot of progress. As you noted, there's some disagreements, but I think it's too early to say exactly how this is going to pan out. I think what we're hearing from companies, though, is that what they really want is certainty, certainty on the tariff landscape, as you already mentioned, but also certainty on the tax landscape so that they can plan for the future better.
Do we have that certainty? I mean, we had that, I guess, a temporary truce, at least right now, between the U.S. and China. But just generally, the sentiment in terms of what you've heard from the president over the last couple of weeks definitely seems to be a little bit more genteel than maybe what he was saying 4 or 5 weeks ago.
Yeah, I think things are certainly trending in a positive direction in terms of a lot of these bilateral negotiations. We obviously saw the U.S. and U.K. make some announcements about a deal. That the U.S.-China deal was certainly welcomed by a lot of companies, a lot of executives around the world. It sort of eases a lot of the short-term constraints, although, of course, tariffs are still high, still significantly elevated relative to where they were in January. So I don't think we're there yet in terms of having that medium to long-term certainty, even though, some of the recent steps have been more positive.
I mean, we've heard a lot of commentary during this earnings season from CEOs and CFOs. And it all seems to be about the same. This general idea that there is kind of a wait and see, if you will. A lot of companies really haven't done anything, adjusted anything just yet because they don't really know where things are going. When do you expect to maybe hear a little bit more, I guess, of a definitive idea of what these companies are going to do if they are indeed going to pivot on some of their pricing, investments, hiring, et cetera?
Yeah, absolutely. There's definitely been a wait and see attitude, although I will say I think things are starting to move. We're seeing some pricing moves, for instance, by some of the bigger retailers and some other sort of B2B companies. So that's certainly something I'm hearing in a lot of the conversations I'm having with CFOs and others. And then I think there's a lot of thinking going on in terms of longer term planning. So maybe not making changes yet until we get that clearer picture and that certainty, but making some scenarios about different ways that the tariff landscape could change, how that might affect supply chains in the future, and trying to think through what some of those no regret moves might be in terms of supply chain diversification, localization, and building resilience.
But that gets to this idea of whether there'll ever be certainty. I mean, we talk about supply chains. We just had a report out of the Wall Street Journal just a few minutes ago that, apparently Trump said that he called Tim Cook and said, stop moving production over to India. I mean, they've been doing this for years now.
Yeah, absolutely. I mean, and this gets to just how complicated global supply chains are, right? It's not just about, the U.S. or China or any other single market. Companies are in so many markets around the world, and their suppliers are in even more markets. So I think what a lot of executives are trying to do right now is really get more transparency for where their supply chains are and think about how they might need to adapt in the future.
Courtney Rickert McCaffrey, EY Global Geostrategy Insights leader. A lot more coming up here on the big program. Stick with us. This is Bloomberg. All right, let's take a look back at this day in history. May 15th, 2014. That was when National Basketball Association Commissioner Adam Silver, that man there, said the league's owners were unanimously approving the sale of the Milwaukee Bucks to an investment group, led by private equity titans Mark Lasry and Wesley Edens for $550 million. That was a lot of money, particularly for a team that had been bought 30 years earlier for just $18 million, and particularly for a team that at the time had the lowest average NBA attendance and played in the 34th biggest TV market. Yet $550 million, that was a record price. Derided at the time, but in hindsight lauded as one of the best investments ever. A prescient investment as evaluations of sports franchises were about to skyrocket. Just months after the Bucks deal, Steve Ballmer bought the LA Clippers for $2 billion. In 2017, Tillman Fertitta bought the Houston Rockets for $2.2 billion. And those deals, that was followed by Joe Tsai's more than $3 billion purchase of the Brooklyn Nets in 2019 and Matt Ashiba's $4 billion purchase of the Phoenix Suns in 2022. And in March of this year, a consortium led by Bill Chisholm agreed to buy the Boston Celtics for $6.1 billion in what would be the largest U.S. sports takeover ever. And so for that $550 million Bucks sale, Mark Lasry has already turned a tidy profit on that, selling his 25% stake in the club in a 2023 deal that valued the Bucks at $3.5 billion. These eye-popping returns have attracted a horde of investors, and not just the billionaire class that can afford to shell out for an entire team. Relatively less wealthy individuals who want even just a small slice of the action are finding a path to do so. NFL owners just 9 months ago voted to let private equity firms buy stakes in their franchises, a move that's already attracting fresh capital while boosting team valuations. And that trend was on display this morning as Dallas Mavericks minority owner Mark Cuban, along with former Atlanta Falcons CEO Steve Cannon and venture capitalist Rashawn Williams, announced the launch of a $750 million private equity fund designed to take small stakes in U.S. pro sports teams. And I'm pleased to say that one of those investors joins me right now. Rashawn Williams is the founder and CIO of Harbinger Sports Partners. You may also, of course, recognize him as a guest host on Shark Tank. Great to have you here, Rashawn. And a really intriguing deal here. $750. You're still going to raise that, over the next couple of years and start putting that money to work when?
Yeah, hopefully much sooner, but probably over the next couple of years. We may start putting money to work pretty soon, actually. We have a lot of interest. We have a lot of deal flow, a lot of relationships. And I think teams and leagues are seeing that we bring a lot of value to some of these organizations to help them as they think about transitioning from sports 1.0 to sports 2.0.
Now, I know you can't talk a whole lot about the fundraising here, but when I saw the 750 million, I kind of thought to myself, that kind of seems low. I mean, there's so much demand in this space. I mean, there's just so much money coming in, and I'm wondering, I don't want to get ahead of you here, but I'm wondering if maybe we're going to have you on in 6 months and that number is going to be a lot higher.
Hey, I'm hoping so. Mm-hmm. But as a first-time fund in this space, 750 is a reasonable amount to deploy capital into North American sports franchises. Mm-hmm. But based on the demand that we're seeing, we do think it will probably be a little larger than that. But I think it's a respectable amount to enter the space.
All right, and you already, of course, have been involved with the NFL's Atlanta Falcons. We should point out this fund that you're starting, it's basically agnostic with regards to the sports league. NBA, MLB, NFL, anything else in there?
Yeah, I would say North American sports, and there's such big opportunities in North American sports right now, like you were just talking about. But as these leagues continue to mature, as media rights continue to increase, as they continue to build new stadiums and own all the real estate around the stadium, basically becoming media companies themselves. So sophisticated capital. Investors want folks who have skin in the game, who have been owners and operators to help Sherpa them into this asset class. Mm-hmm. And one of the things that's important from an investor standpoint is non-correlated to the equity market. So as a former venture capitalist and tech guy, I needed to diversify out of tech myself. So I started redeploying my assets into this space about 5 years ago. And I think you're starting to see that trend a lot with family offices and institutions.
With the involvement now of more private capital in this space, now that some of these leagues have loosened the strings on that and you have more investor interest, is that going to create distortions when it comes to valuations? I pointed out the $6.1 billion deal for the Celtics, which would be the biggest deal for a sports franchise ever, at least in North America. But I should point out, there was actually a story earlier today that apparently the San Francisco 49ers are in play at a valuation of more than $8 billion if that were actually to go through.
That's right. That's right. On the cover, it appears that more private equity coming in is going to drive the prices up. But if you peel back the layers, you'll see private equity is not allowed to own majority stakes in most of these leagues, just minority stakes. They're all capped at small percentages that private equity can own. So the majority stakes and the control owners of these teams are still families. They're still individuals. They set the price because they're buying the majority of the team. Private equity comes in as a partner to help provide liquidity to shareholders and owners who've been around for a while, guys that are thinking about succession planning, guys that need cash in order to build new stadiums, and all of the other reasons that people want liquidity when they don't have IPOs or M&A. So private equity becomes a great strategic partner to shareholders and to the ecosystem.
So what are the rules like right now? Because when we talk about, the NFL allowing private equity in, I know on a high level, right, the idea is that you can't really have, more than 6 franchises. Is that as a majority investor or as a minority investor?
Yeah, so we're only talking about minority investors when we're talking about private equity firms. So there are some things called league beneficial owner rules. Every league has different rules, but it used to be uncapped. You can have 50, 60 owners of a professional sports team in North America, 30, 40 years ago. Mm-hmm. Today, they tend to cap it at, maybe 24 owners. So what happens is as valuations get higher and higher, and people who got in at $200 million and it's worth $3 or $4 billion now, sometimes they want to take some chips off the table. And they can't sell to another owner because that owner is like, hey, I was in at $200 million with you. I'm not going to pay $3 billion. And if they sell to someone else, it trips over those league beneficial owner rules. So private equity comes in and they're largely exempt from those rules. Private equity doesn't count as a limited partner or as an owner. So they can come in and relieve that pressure on the cap table and start helping with liquidity programs for some of these owners that want liquidity.
For your fund, though, I mean, generally you're targeting 5% or less? Is that the general idea in terms of ownership stakes, or is there no?
Yeah.
Yeah, okay.
Yeah, so we're working right in the guidelines that each of the leagues in North America has already set, and it's really small stakes, right? You're talking about 1% to 5% stakes in teams. You'll have multiple private equity firms investing in the same team, but you'll never have, won't say never, it's unlikely that you'll have private equity firms buying a majority of a team and controlling the entire. These are family-run, individually run teams and leagues.
I think it's kind of interesting, too, Rashawn. We've talked a lot about the business of sports and all the investment coming into sports, but often that conversation has been about more, I guess, newer sports, if you will. You know, you're talking volleyball, lacrosse, pickleball, things that haven't traditionally been prominent in the U.S. zeitgeist. You're going all in for the granddaddies of U.S. sports here. And I do wonder, though, because, I don't know what to call this. This isn't early stage investing. I don't know if it's late stage. I don't know what it is. It's behemoth investing. And I do wonder if that carries any sort of risk that you've had to sort of talk about.
It absolutely does, and you're spot on. I'll give you the best comparison I can give you in tech. That's the ecosystem I've been in the last decade. So there's early stage, growth stage, and then late stage risk. Early stage, an idea, very little revenue, very little traction, tons of upside, high risk. That stuff takes 10 to 15 years to make money. Only 1 out of 10 make it, right? Think of the early stage sports leagues that you're seeing out there. They're popping up every day. In fact, once we made this announcement on this new fund, I got 50 emails from leagues that I never even heard of. Now, then you have growth stage, and those are teams and leagues that have been around for a while. Maybe they're not profitable yet. They're still growing really fast. They're close to getting to that mature level, like late stage, but they're on their way, right? I would consider WNBA, I would consider Major League Soccer great opportunities. But still, sometimes you have to do a capital call. They have to fund their losses with raising more capital and sometimes diluting shareholders. Now, at the top of the food chain are the late stage or the mature leagues, the basketball, football, baseballs, and they're largely profitable. They very rarely do capital call. There are a few exceptions. They want to win the championship and just start spending a bunch of money. But for the most part, they're stable. They've reserved money in case of a COVID or a player strike. Right? And you're not really getting capital calls on them, but stable, expensive assets with a long-term stream of cash flow. Those are the safer late-stage assets.
What makes, in your view, a good investment in a sports franchise or a sports team? Like, what are you looking for? Do they need to be, I guess, winners, if you will? You're going to go after the Philadelphia Eagles? Or, can you maybe go we started off talking about Mark Lazary. He bought the Bucks when it was an awful team, let's just say it. And of course, he rode that wave to, a team that, basically became championship contenders.
Right. So there are fundamentals and then there are technicals. So what you see oftentimes with sports, it crosses over to the passion play and folks were willing to pay whatever price that they need to pay in order to win, the opportunity. Those are more technicals, right? I want this. I'm from Boston. I want to own this team. This is the only basketball team in Boston, right? So the technicals go really strong for local Boston billionaires who want to own that team. But the fundamentals, the most important part of actual tech of sports teams investing is having the strategy that's appropriate for you as an investor. So again, if you're looking at early stage leagues and teams and only 1 out of 10 make it, it's your job to find 10 to 20 of the fastest growing, best teams and leagues in that space, and then try to get the best price you can on all 10 or 20, knowing only 1 out of 10 make it. If you're only going to do 3 investments and only 1 out of 10 make it, that's not a good strategy. So you're guaranteed to lose money there, right? But for the late stage, when you're looking at the big 3, you're looking at these profitable teams, what you really want to do is look at the management team, you look at the owners, you look at the market that it's in, the percentage of revenue that's coming from media, the percentage that's coming from league and local revenue, and you see what their plan is to grow their revenue in the ways that they can control, which is largely local revenue. Here are the 3 things I would look at if I had to summarize for you. Number 1, are they operating under the assumption that they're just relying on the league for most of their revenue and they're not looking for, local revenue growth opportunities? Number 2, if they are looking at local revenue growth opportunities, building and owning a stadium, renting the stadium out for concerts, whether or not they have pricing power to increase prices, using predictive analytics, there are a bunch of things you can look at to drive more revenue locally. Here in Atlanta, just look at the Battery, right? Look at what the Braves are doing, hotels, office space. This is all flowing through. Chicago Cubs are doing something similar, buying up all the real estate around around. There are teams that don't even own their stadium. So they're largely capped. And then number 3, are they really looking at themselves as the future of sports, taking this content that they're creating and monetizing it in additional ways?
All right, really fascinating stuff. We've got to get you back on to get some of that progress. The $750 million private equity fund taking small stakes in U.S. sports teams and being helmed here by quite the trifecta here. Mark Cuban, Steve Cannon, and the guy there on your screen, Rashawn Williams, the founder and CEO of Harbinger Sports Partners. We'll be back in a moment. This is Bloomberg. All right, welcome back. Just a few days ago, the Trump administration proposed cutting about $6 billion from NASA's budget. That sent a lot of the shares of companies in the space race lower here on that day. Joining us right now to talk a little bit more about this and whether it will actually come to fruition, let's bring in Lauren Grush. She joins us right now as Bloomberg reporter. Hey, Lauren, when I saw this story last week, it was this idea here that a $6 billion cut in NASA funding is the idea that this is just money that's going to be sort of, I guess, shifted to the private sector, or are we really just talking about overall a wholesale drop in the amount of money that we're going to be spending on space programs?
I think, well, if you look at the cuts that we've seen in the skinny budget, a lot of it is targeted at space science specifically. There seems to be an increase, at least a projected increase, for human spaceflight initiatives. So it seems to be targeted at a certain type of, or certain programs within NASA. So I think you could say that some entities would see a big loss here, while other companies that are more focused on human spaceflight might see more opportunity.
All right, Lauren Grush, Bloomberg News reporter, a closer look here at some of the budget proposals coming out of the White House that could actually affect NASA and overall the investments that we're making in that space race. But that doesn't mean those investments aren't happening. They are happening on the private side, and we do want to continue that conversation about the business of space. Bridget Mendler is the co-founder and CEO of a company called Northwood. It's a space startup, and it's on a mission to build a data highway between the Terra, Earth here, and space, and just recently raised $30 million. In its latest funding round. Bridget, great to see you.
How's it going? Good to be speaking with you.
I'm doing well. I'm absolutely fascinated by this business because when we talk about space, there's been so focused over the last few years on all these rockets that Musk and Bezos and other folks are launching into space and the satellites floating around out there. Your approach is a little bit different. You're focusing on what's going down here on Earth and how we communicate with what we're sending up in space. Explain.
Yeah, absolutely. I mean, ultimately, at Northwood, we want to put space to work for people on Earth. And our hot take is that the big problem to solve doesn't start in space. It actually starts on the ground. And so that's why we're building a network of antennas on Earth that connects to space, and it enhances what space missions are capable of. I think folks, don't really necessarily realize how integrated space is into our everyday lives. When you're swiping a credit card, when you're turning on a light switch, you're connecting to time signals that are being sent from space to keep the grid on and allow financial systems to run. And so for us at Northwood, we want to protect those critical services, but we also think that that's just the beginning of the story of what space can do for people on Earth. So we're building a network of ground stations that satellite businesses can use as a foundation to do more ambitious things.
So forgive me for the dumb question, but why doesn't this already exist, these ground antennas, or do they?
They do exist, but they have a limited level of connectivity. There's just not a large enough number of them, which limits the kind of services that you can provide. For example, satellite imagery has actually become so good that you can give actionable information to firefighters to help put out wildfires. So it's not actually the tech that's on the satellites that limits the potential for that, but it's the fact that they can't reliably contact the ground within a time period that's relevant enough, like 15 minutes, in order to actually have those images taken and deployed to the firefighters on the ground. So if they were able to have more capacity and more connectivity on Earth, then that changes what those missions are capable of. And it also opens up a whole lot of other mission possibilities as well.
With regard to what you're doing, as well as some of your competitors, as well as other folks adjacent to you in this space, how much of this is just being driven by private companies like yourselves, and more importantly, private money? Is there government involvement? Is there government money actually also helping to sort of push these efforts forward?
Yeah, I mean, the government has very similar problems. They're also dramatically under capacity. And so one of the problem areas that we're focused on in our early days, we ultimately are building a network that aims to serve the majority of satellite use cases. But initially, we're focused on a more narrow slice called command and control, which I describe as kind of like the remote control of satellite operations, where, a satellite's like the remote control car that requires instructions from a remote control that's back on Earth. That's the antennas that we're building. And so that is the case across a wide variety of missions, both commercial and government. And so we are building a product that can support 10 simultaneous links at once, and it can go across multiple orbits. So you compare that to antennas today that can only contact one satellite at a time from a single orbit. And so we are not just building one of those systems, we're building dozens. And that is a scale of capacity that's similar to what both commercial and government networks have been able to accomplish over decades. And so we're seeing both government and commercial appetite for more of those kinds of services.
With regard to controlling the antennas and more importantly, I guess, getting the data up, from them or pushing whatever data you need out of them here, is that done from like a centralized location, or do you have to actually be in close proximity to where these antennas are?
So that's controlled by the customer. The customer controls being able to direct their satellite. We're just a pipe to send the data.
So when we talk about the potential growth for your business, and there are a couple other competitors in this space as well, I mean, what is, I guess, the addressable market, for lack of a better phrase, that you see out there?
The addressable market is the space industry. The solution that we're building is a common set of infrastructure that's required across the entire industry. So I like to think of infrastructure from space kind of in three core pillars. There's the things that you put up into space, which are satellites. There's the way that you get them up into space, which is launch. And then there's what you can actually do with them once they're up in space. And if you don't have a ground network, then you just have a bunch of expensive metal circling the Earth up in space. And so it's the ground network is that core common piece of infrastructure that sits across the entire space industry. So the market, you could say, is quite large.
And are you already planning a next funding round, or is it too early to talk about that?
We're focused on building. We have big ambitions, as you can imagine, aiming to build a global network. We're planning to actually be multinational operations this year. So we're focused on building and deploying the technology. I think there's been an overwhelming response of interest in what we're building, and so that's the next thing for us to prove is, can we translate that into an actual operational capability? And looking forward to getting some tech out in the field.
All right, and we're looking forward to talking to you again as we sort of chart your progress of that company. Bridget, really fascinating stuff. Bridget Mendler is the co-founder and CEO of Northwood, building these ground antennas to communicate with the satellites out there in space. We do want to get to some breaking news crossing the wire on Live Nation. Those shares moving lower in the after-hour trade after we're learning that the U.S. Department of Justice is conducting a criminal antitrust probe into how companies responded to mass concert cancellations at the onset of the pandemic. The focus right now is on Live Nation and AEG Presents and whether they illegally colluded on refund policies. This is according to people familiar with the matter that our Bloomberg reporters have spoken to. We have reached out to the companies for a comment, and we are still awaiting to hear from them. We'll be back in a moment. This is Bloomberg. All right, here are a few things out there that could move markets over the next 24 hours. That includes economic forecasts, those spring economic forecasts out of the European Commission. A closer look here at the big trading block over there in Europe. Meanwhile, back here in the United States, 8:30 a.m. Eastern time, we are going to get a read on housing starts, which of course contracted in March. They're expected to have continued their growth or resumed growth back in April. We're also going to get a read on University of Michigan sentiment numbers that have been falling for 4 straight months. That's actually expected to show a bit of a rebound as well. And all eyes still on the President of the United States as he wraps up his trip to the Middle East. That does it for the close. Stick around. Balance of Power is up next.
Stock in natural gas future buy at 272. 272. You have to exit then. काफी ऊपर से ले लिया 272. Here is 272. एटलीस्ट 270 से ट्राई करना चाहिए था सो दैट 2 पॉइंट ऐसा ही बनता इफ एसएल इज गॉन एग्जिट, ठीक है, बायर ही नहीं दिख रहे, स्टिल होल्डिंग, अभी ब्रेक डाउन नहीं हुआ है until unless एसएल इज नॉट गॉन। बाकी क्रूड ऑयल में भी देखोगे थोड़ी बहुत सेलिंग आई थी। यहाँ पर ध्यान रखना, ये मैंने थोड़ी देर से पहले बताया फॉरेक्स में यहाँ पर 2 बार सेलिंग आ चुकी है। एक बार अर्ली मॉर्निंग आई थी 3:30 के अराउंड, दूसरी बार ये एक सेलिंग और आई है, ये थर्ड टाइम सेलिंग थी यहाँ पे। दिस इज द फोर्थ टाइम, नाउ इट इज टू वीक, दिस इज द फोर्थ टाइम प्राइस हिटिंग दिस लेवल इन क्रूड ऑयल, बी अवेयर, ठीक है। फोर्थ टाइम हिट कर रहा है इस लेवल को, ये 3 बार कर चुका है, 2 बार फॉरेक्स में, 1 बार एमसीएक्स में। एमसीएक्स के अकॉर्डिंग नेक्स्ट सपोर्ट ओवर हियर यहाँ पर रहेगा। बाकी देखते हैं, 9 PM हो चुका है, 2 घंटे और है मार्केट में। बाकी नेचुरल गैस ने काफ़ी ट्राई किया, होल्ड नहीं कर पाया, लेकिन कंप्लीटली सेल ऑफ है आज। 6% लोअर सर्किट लग गया है, 5.99% डाउन है, मतलब फर्स्ट लोअर सर्किट, इट इज़ ऑन द फर्स्ट लोअर सर्किट। लेट्स सी, अगर यहाँ पर भी होल्ड नहीं करता ये, और कहाँ जाएगा। लेवल पे था अच्छा नेचुरल गैस, ये कैंडल ही ओपन इक्वल टू हाई बन गई, उसके बाद रुकने की कोशिश करी, बट आज बायर का दिन नहीं है नेचुरल गैस में। सी और कितना नीचे जा सकता है। नॉट राइट नाउ। क्रूड ऑयल का भी एमसीएक्स में नेक्स्ट रेजिस्टेंस आपका ऊपर 5368 के आसपास मिल जाएगा, इसके बाद वो एक अच्छा लेवल रहेगा एमसीएक्स के अकॉर्डिंग फिर से सेल करने का। पहली बार ही आएगा प्राइस वहाँ पे। अभी उसमें आया नहीं है ना वो, बढ़िया है, कोई इशू नहीं है। थ्री काफ़ी है। लोअर सर्किट ओपन हो गया है नेचुरल गैस में, लेट्स सी कैंडल क्लोज होती है नहीं होती, ब्रेकडाउन करता है नहीं करता, या फिर लेवल को होल्ड कर पाता है। अभी ब्रेकडाउन हुआ नहीं है, कैंडल ओपन इक्वल टू लो अगेन, ओपन इक्वल टू हाई, सॉरी। नेचुरल गैस और कितना गिरेगा, ये सपोर्ट ठीक है, होल्ड करना चाहिए, देखते हैं। अभी ब्रेकडाउन हुआ नहीं है, अगर ब्रेकडाउन रिटेस्ट हो गया तो फिर वही 260 तक जा सकता है, और बाकी होल्ड तो करना चाहिए। लेट्स सी कैंडल क्लोजिंग देता है ब्रेकडाउन सक्सेसफुली, या फिर सिर्फ फेक ब्रेकडाउन करके ऊपर निकल जाता है। किया 268, तो फिर 260 तक और जा सकता है नीचे। From natural gas future, no capacity to hold anymore. थोड़ा जल्दी ले लिया आपने 272 पे। You took position over here. वैसे ही एसएल आपका 5 पॉइंट का हो जाएगा, 4 पॉइंट का सॉरी। लेवल पे लिया करो सो दैट एसएल तो एटलीस्ट छोटा हो। अभी ब्रेकडाउन हुआ नहीं है बाय द वे। लेट्स सी मार्केट रिकवर करता है तो इट इज स्टिल ऑन सपोर्ट, नेचुरल गैस स्टिल ऑन सपोर्ट। एक लोअर सर्किट जरूर लगा था बट होल्ड कर गया अभी भी। ये थोड़ा सा अगर यहाँ से ना ऊपर आता है तो फिर ऊपर से भी यहाँ से हो जाएंगे। बाकी आज तो मार्केट ने एक पुल बैक भी नहीं दिया नेचुरल गैस ने, कंप्लीट फॉल। गोल्ड एंड सिल्वर, या गोल्ड तो देखोगे फॉरेक्स की अगर बात करूं तो आज पूरा ही साइडवेज चला गया था, कुछ मोमेंटम ही नहीं हुआ 15 मिनट टाइम फ्रेम पे। एमसीएक्स देख लो, फॉरेक्स देख लो, फॉरेक्स भी रेंज के अंदर है, एमसीएक्स भी रेंज के अंदर है, तो इट इज साइडवेज कम्प्लीटली। एक फ्लैग बन गया है, लेट्स सी अब ब्रेक होता है तो। बाकी मैं साइडवेज ही कहूंगा इसको। ऊपर वो एक आइडेंटिकल रेजिस्टेंस था, वो अभी तक ब्रेक हुआ नहीं, बट जिस तरह का पैटर्न बन रहा है एक आइडेंटिकल रेजिस्टेंस है, हाई चांसेस हैं ब्रेक होने के अब। तो इट इज साइडवेज इन 15 मिनट। बाकी अगर ऊपर ब्रेकआउट है, एक रेजिस्टेंस है 15 मिनट टाइम फ्रेम पे, लेट्स सी ये ब्रेक कर पाता है तो। ब्रेक किया तो मोमेंटम बहुत बड़ा आ जाएगा गोल्ड में, क्योंकि जिस तरह का प्राइस एक्शन है ना बिल्कुल परफेक्ट है ब्रेकआउट के लिए। लास्ट टाइम सेलिंग आई थी 2257 के अराउंड, लो बनाया था 3125, फिर से उसी लेवल से सेलिंग आई थी, हायर लो बनाया था, फिर आज सेलिंग आई फॉरेक्स में और अभी उसी लेवल पे रुका हुआ है। तो एक आइडेंटिकल रेजिस्टेंस पॉइंट है अगर ब्रेकआउट होता है। लेट्स सी, ब्रेकआउट होना भी जरूरी है, तो अभी साइडवेज ही है रेजिस्टेंस पे। बाकी होगा नहीं होगा ब्रेकआउट वो अभी कह नहीं सकते, बट है रेजिस्टेंस पर ही। कई बार फेक ब्रेक कोशिश भी करता है कि फेक हो। ब्रेकआउट लेवल क्या रहेगा फॉरेक्स में? 3256-57 मान लो। वैसे अगर राउंड नंबर लेना है तो 3260 भी ले सकते हो, बट एग्जैक्ट बता रहा हूँ 3257। 3257 ब्रेकआउट हुआ नहीं है रेजिस्टेंस पर ही, बट इतने बार सेलिंग आ गई है इस लेवल से, देखोगे अब ऐसा लग रहा है कि ये अगर ब्रेकआउट हुआ तो बड़ा मूव कर जाएगा। काफ़ी दिनों टाइम से रुका हुआ है, ये फॉरेक्स का चार्ट है। लास्ट टाइम सेलिंग आई थी, यहाँ से एक लो बनाया था, फिर ये हायर लो, फिर से हायर लो और फिर से हायर लो। अगर ये ब्रेकआउट हुआ तो फिर अच्छा खासा चला जाएगा ऊपर, बट जब तक होता नहीं तब तक कह भी नहीं सकता भी ब्रेकआउट होगा, तो इट इज स्टिल ऑन रेजिस्टेंस। देखते हैं ब्रेकआउट कर भी पाता है या फिर नहीं, या फिर वापस नीचे ही आ जाता है। बाकी अगर ब्रेकआउट हो गया सक्सेसफुली तो फिर आप एक्सपेक्ट कर सकते हो ऊपर 3325 का लेवल। बाकी अगर ब्रेकआउट नहीं हुआ तो फिर नीचे आके रुकेगा डेलो पे 3200 के अराउंड। वो नीचे एक सपोर्ट है 15 मिनट में। नहीं, अब कोई डेटा नहीं है आज, सब के सब एफओएमसी मेंबर की स्पीक। क्रूड ऑयल भी देखो वापस रेजिस्टेंस पे पहुंचने वाला है एमसीएक्स के दोबारा। ये भी न्यूज़ आई थी उसके बाद कंप्लीटली बुलिश हो गया वो इजराइल वाली। श्योर, कोई नहीं। कैंडल का ध्यान रखना ओपन इक्वल टू लो ना बना दे बस, अदरवाइज येलो कलर के बॉक्स से एंट्री हो जाएगी। 9:30, 2 घंटे और हैं। बाकी वॉल्यूम डाउन हो सकता है, ध्यान रखना 10:30 के बाद, तो 1 घंटा ही मान के चलो, जितना मोमेंटम आ गया आ गया। अभी भी सपोर्ट पर ही है, एक लोअर सर्किट जरूर लगा था बट ओपन हो गया तो इट इज स्टिल होल्डिंग। देखते हैं सपोर्ट होल्ड होता है नहीं होता, क्योंकि अगर ये सपोर्ट होल्ड नहीं हुआ तो फिर प्राइस अच्छा खासा और नीचे आ जाएगा। तो सपोर्ट अच्छा है, होल्ड होना चाहिए सपोर्ट नेचुरल गैस में। ये इस लेवल पे आया था 6 बजे, ऑलमोस्ट 9:30 हो गया, 3.5 घंटे से इसी लेवल पे रुका हुआ है प्राइस। ठीक है, क्रूड ऑयल सॉरी गोल्ड नहीं जा रहा है ब्रेकआउट पे, अभी भी होल्ड पे है। क्रूड भी अच्छा खासा हो गया कल से, जितना सेल ऑफ आया था आज फ्लैट है अभी तक। इतना काफी होगा, इससे बड़ा कौन लेगा। दैट इज इनफ। आ जाती है 94। हाँ ठीक है, ठीक है, होल्ड कर रहा है। नेचुरल गैस ने अभी भी ब्रेक डाउन नहीं किया, इट इज स्टिल होल्डिंग। ठीक है, जब तक ब्रेक डाउन नहीं होता, कैंडल क्लोज नहीं होती, तब तक इसको सपोर्ट में ही मानेंगे। देखते हैं मोमेंटम आता है नहीं आता। इंपॉर्टेंट ये है क्योंकि ये सपोर्ट पे रुका हुआ है ऑलमोस्ट 3.5 घंटे से। ऊपर जाएगा नहीं जाएगा या साइडवेज ही रह जाएगा इस सपोर्ट पे, दैट इज कंसर्न। क्योंकि अगर साइडवेज ही रह गया तो फिर मोमेंटम ही नहीं होगा। वैसे ही मंडे है, 9:30 हो चुका है, आए 1 घंटा और कह सकते हो मोमेंटम पॉसिबल है। जब तक वो जाएगा नहीं 2 तब तक सपोर्ट ही है। लेट्स सी। नेचुरल गैस में फिर से एंट्री कहाँ कर सकते हैं, कहीं सपोर्ट पे कहीं पर भी कर सकते हो सर। कैंडल जब तक क्लोज नहीं होगी नीचे, तब तक वो सपोर्ट पर ही माना जाएगा। मतलब क्लोज भी नहीं कहेंगे, ब्रेकडाउन रीटेस्ट नहीं होता। बट ध्यान रखना मोमेंटम होगा नहीं होगा, वो एक अलग क्वेश्चन है। और अब कैंडल क्लोजिंग का लेवल नेचुरल गैस में डाउन साइड पे 265 रख सकते हो, 265.5। जब तक उसके नीचे कैंडल क्लोज नहीं होती, इट इज सपोर्ट। देखना है कितना मूव और करता है। वहाँ तो गया थोड़ा और। नॉट दिस ये भी नहीं है, ये है। ये फर्स्ट सेकंड। ठीक है, ऊपर जाएगा तो वही 275 के आसपास का ही है एक टारगेट, जहाँ जाने की प्रोबेबिलिटी सबसे हाई है। 265 ध्यान रखना, 265 ही है। उसके नीचे ही कैंडल क्लोज होगी तभी ब्रेकडाउन मानेंगे, अदरवाइज ब्रेकडाउन नहीं मानेंगे अभी भी। नेचुरल गैस में सपोर्ट ही कंसिडर किया जाएगा, भले ही बाइंग आए ना आए अलग बात है। साइडवेज भी चला गया तो सपोर्ट पर ही कंसिडर होगा। बाकी अब वापस अगर 6% डाउन भी होता है तो लोअर सर्किट लगेगा नहीं, क्योंकि एक लोअर सर्किट लग चुका है, तो सीधा दूसरे लोअर सर्किट पर ही रुकता है प्राइस। तो लेट्स सी 273 275 तक चला जाता है तो आज। क्रूड ऑयल भी रेजिस्टेंस पर ही है, ध्यान रखना इसमें भी एसएल आपका 5395 के आसपास, उससे बड़ा एसएल लेना मत, इनफ है उतना। इसमें ले लिया इसने यार यहाँ पर ये, व्हाट अबाउट दैट, ओपन इक्वल टू लो, ओपन इक्वल टू लो कैंडल बना दी थी इसने 530 वाली। व्हाट अबाउट दैट, no not this one, the, oh, एनीथिंग ओवर यहाँ पर एक उसमें है, उस वाले चार्ट में। तो वैसे भी कॉस्ट टू कॉस्ट पर ही है। इसमें किसी को फिर से री एंट्री करनी है तो हल्के से पुल बैक में वापस री एंट्री कर सकता है, ठीक है। अभी भी ब्रेक नहीं हुआ है, बट ध्यान रखना क्योंकि कैंडल विक बना दी है उसने नीचे, तो वो सेम एसएल नहीं लेना, एसएल 265.5 के अराउंड रख सकते हो, उसके नीचे कैंडल क्लोज होगी तभी ब्रेकडाउन मानेंगे अगर वापस री एंट्री करना चाह रहे हो। वैसे तो अभी भी सपोर्ट पर ही है, बट एसएल अब वो सेम नहीं रखा जाएगा। सेम ही है वो दोनों के लेवल ना. I think both the level are same. क्रूड में वही न्यूज़ थी, उसके अलावा तो और कोई न्यूज़ थी नहीं इजराइल वाली. That is a positive news for crude oil. इजराइल के प्राइम मिनिस्टर ने कहा है कि हम गाजा को पूरा कंट्रोल करेंगे. Oh, look at that. What about this? First, second, third. Weekend close होनी चाहिए थी. डायरेक्टली होनी चाहिए क्या? नेचुरल गैस में फिर से आता है हल्का सा पुल बैक, तो वापस री एंट्री कर सकते हैं. क्वांटिटी का थोड़ा ध्यान रखना, ऐसा ना हो साइडवेज ही चला जाए पूरा सपोर्ट पे, क्योंकि साइडवेज ही चला गया तो कुछ मिलेगा नहीं.
As my birthday signals another milestone in my life, I'm hopeful that if I stay true to myself and follow my instincts, my legacy will be looked on kindly. For
Indian Defence Ministry-led research group alleges that China provided air defence and satellite support to Pakistan during its recent clash with India. It suggests Beijing was more directly involved in the conflict than previously disclosed. For more on what this means for ties, just as India and China were beginning to mend relations after several years, we're joined by government reporter Sudhi Ranjan Sen. Sudhi, how exactly did China help Pakistan during that conflict?
Well, from what we are getting to hear from the government right now is that China helped Pakistan reorganize its air defense, and at a very critical time. And this is just after 26 tourists in Kashmir are killed. And there is a clear statement that is coming, or an statement of intent coming from Prime Minister and the Government of India, that there is going to be retaliation. So it clearly shows a direct involvement of China, which we did not know. In addition, what we have reported is that China adjusted its its satellite passes over India to kind of pick up the deployments, the movements of the military on the Indian side, and the assessment is that these were passed on to Pakistan. So it's a much more direct involvement than just the use of weapons that was known to everybody, and this is kind of coming out for the first time from India.
And this wouldn't sit well with India. What does it mean for India-China ties when, they're just beginning to warm up?
Well, this would be a huge hurdle. This would be one of the major factors, that now India will have to consider. In fact, what we are also getting to learn that now India kind of plans in its, when it's planning for possible conflicts, hostilities in the neighborhood, it plans for a joint front between of China and Pakistan, which is a kind of a complete game changer if you look at it, because then therefore the frontier that India will have to look at when it's planning its military capabilities and strategies is as long as 700 something around 7,000 kilometers long, which is a huge frontier. There is no difference therefore between the western borders with Pakistan and the northern and eastern borders with China. So that is a huge change that the military is looking at.
Sudhi, is there a sense of how Chinese weapons, in particular Chinese air defense, performed in that conflict?
The assessment that that has been shared with us very clearly says that the Chinese air defense equipments performed below par, and in some cases they just could not do the job that they were supposed to be. Although we have seen Pakistan talking up Chinese weapons, we have not heard anything so far from Beijing. But India's assessment is that these weapons are below par, and China has been using Pakistan to kind of battle test their weapons. Mind you, these systems have never ever been tested before.
As my birthday signals another milestone in my life, I'm hopeful that if I stay true to myself and follow my instincts, my legacy will be looked on kindly for generations to come.
Good Monday. Good Monday morning. Lots to talk about. We're going into the open today. Hong Kong, Shanghai, and Shenzhen just under 30 minutes away. You're watching the China Show. I'm David Ingles. Let's get to your top stories today. The dollar and U.S. futures are weakening. That's after Moody's rating strips the U.S. government of its top credit rating over its ballooning debts. We have HSBC's global head of fixed income research joining us in a few minutes to talk us through those stories and the implications of such. Now, the impact of U.S. tariffs could go up in China, could show up at least here in China's activity numbers coming through this hour for April, this morning at least here, before both sides, of course, reaching that temporary agreement to reduce those levies. Now, we're live from Taipei at Asia's biggest tech show, Computex, featuring industry leaders, including NVIDIA's Jensen Huang. Plus, we hear exclusively from Chinese auto players Zhejiang Leap Motor and Yihang amid, of course, this tariff uncertainty. We'll hear about a business and also be speaking with the CEO of Hero Esports for Asia's first international multi-title tournament taking place this week in Shanghai. Good morning and welcome to the show. So we were jolted into the weekend as that big announcement came towards the latter part of the U.S. session. And then obviously we got out of bed this morning, up and running to the downside across U.S. assets. And we're now pushing 1% to the downside on the NASDAQ futures. On the U.S. Treasury curve, it's really on the long end where you are seeing the most pronounced reaction. And as you can see, 497, 5% is the next level to watch. Beyond that, 511 perhaps is that level we hit back in 2023. Beyond that, 511 is a level we last saw prior to that back in 2007. Right, let's flip the page, please, and have a look at where we are across the region here. So you have Asia coming, there we go, just about flat. You have Taiwan coming online, 0.5% to the downside. Nikkei's bottom of your screen. So broadly, risk aversion, not a lot. It's going to take us really take time to get warmed up. Of course, as far as data goes today, the big one is, well, in the next 27 minutes, home prices out of China. In the next hour, activity numbers for the month of April. And we'll see how that played out. Of course, I guess in some ways backward-looking, given, of course, that was the full month of following Liberation Day announcement, but before, of course, this sort of de-escalation that's taken place in the last two weeks or so. Right, let's please have a look at where we are, A50 futures also. And there we go. Thank you so much. So we are slightly to the upside. China 10-year yield 168. So you do that with a 30-year. Are we poised for a flattening at some point along those lines? Dollar China 720.55, which effectively puts us extremely close to the low of 20.25, and that could obviously happen depending on what the data looks like, or before that, actually. We'll see what the fix looks like coming out of the PBOC. The first one of the week should be out in about 12 minutes from now. Right, that takes us into the agenda for today, and so we have activity numbers coming through. We talked about the data. We talked about the lows, perhaps, on dollar China. We have a lot of earnings coming through in the form of, I think it's Alibaba Health, CLP, and I think it's Leapmotor that's coming out with earnings today, so keep an eye on that. We are in the window for FDI numbers coming through. And also, on Friday, in case you missed that, fairly relevant given the market reaction already we saw in the U.S. session to shares of ZTO, which were up double digits. So some changes to the benchmarks here in Hong Kong. Hang Seng goes from 83 to 85 in terms of the number of members, and you have two being added to the benchmark. Those two, you have BYD being added to HS Tech, and to make way for BYD's China Lit being removed from HS Tech. So watch out for any potential or likely reaction as far as those are concerned. Right, okay, let's talk about the other big story, of course, still the stripping of AAA coming out of Moody's. You had the Treasury Secretary Scott Bessent downplaying concerns over Washington's government debts, and certainly comes after the U.S. credit score was lowered to AA1 from AAA on Friday, joining its peers Fitch. And of course, years and years back, you had S&P, of course, coming through with that. Speaking to NBC, Bessent called Moody's a lagging indicator of U.S. fiscal health.
We didn't get here in the past 100 days. It's the Biden administration and the spending that we have seen over the past 4 years. We inherited 6.7% deficit to GDP, the highest when we weren't in a recession, not in a war, and we are determined to bring the spending down and grow the economy.
And as we were pointing out, really the downgrade is weighing on U.S. assets. Broadly speaking, risk assets. So you look at the dollar, you look at where treasuries are moving right now. Look, U.S. futures. I think the dollar is still down against every single one of its G10 peers as I speak. Mary Nicola is with us right now to talk us through this out of our MLive team. Mary, where is your head at the moment, looking at what happened on Friday and certainly the continued reaction we're seeing Monday morning?
Yeah, I think as Scott Bessent pointed out, it's more about, it's not that they downgraded and we know that it's a lagging indicator, but it's more about the fact that the policy uncertainty still lingers. Last week we were talking about tariffs and the and potential tariff reprieve between the U.S. and China. And now this week, as we kick off the week, it's more about the budget concerns. Now, but the budget bill has been in talks for some time that the House is discussing, and they're expected to bring this one big, beautiful bill to discussion by the end of May. However, one of the key things is that in the run-up to the discussion, it seems that more of the focus is on tax cuts than spending restraint. So, of course, that brings out a lot of concern about how wide is this fiscal deficit going to be, what is the potential ramifications, and, of course, calling into question about the debt sustainability of the U.S. And that is what is putting a lot of these risk assets under pressure.
And Mary, how does that set up the week for us, really, in a sense that, I mean, to your point, dollar's been on the back foot. That's really given, I guess, a platform for EM assets. Are we expecting the same this week? Any consequential, perhaps, development coming through, depending on what the China numbers look like today as well?
Yeah, I think one of the big things, especially out of this Moody's downgrade, and especially the focus on the fiscal budget, is that we're within reach of the S&P 500 reaching its all-time high. That momentum is going to be questioned. So this sell America trade is going to come back to haunt U.S. stocks, U.S. treasuries, and of course the dollar as well. And then of course you have the G7 meetings coming up, and so there's a lot of discussion about whether FX is on the table. We already know that it has been flagged by the Japanese finance minister that it will be discussed. So of course there's going to be a lot of discussion in terms of, we have already seen an advancement of the Taiwan dollar. So what does that mean for the rest of Asian currencies? Because does that become part of the trade deals? And so I think a lot of what you'll see is, especially if you see dollar downside, that reignites the Asia focus and Asia currencies in particular, that they can see further gains as a result. And then, of course, we have the China trade data, that's the China data dump that's coming out today. And of course, yes, it may be backward looking, but it still doesn't show any signs that there is going to be a resurgence, because we look at container ships and the way the ships have been moving from, there hasn't been that resurgence that you would expect even with the reprieve.
Mary, thank you so much for setting up the day and the week for us. Mary Nicola in Singapore for us. Let's bring in Stephen Major, Global Head of Fixed Income Research at HSBC, who was just glancing right now at the shape of the U.S. curve there. The long end's not liking this one, Steve.
No, well, 5% is within reach. Yeah. And it does seem that it's the 30-year bond that's getting the most pain here. So 10-year yields are still lower than the high for the year. Yeah. And I think it's going to be a concern for the Treasury that we're getting to this level. But then again, who actually buys 30-year bonds? It's kind of a specialist niche. So that there might be insurance companies, pension funds, and then there'll be others who play the shape of the curve and are doing very well with the steepening between 10s and 30s and 5s and 30s. Right? Yeah. That's been a winning trade for the last few months, really. So the question is, what is the path to those yields going back down? And at the moment, you can't really see it, because we were thinking the data was cooling. And I think many asset managers, fixed income asset managers, equity asset managers, were positioned for a cooling, slowing economy, and were maybe caught out by the risk on that came after the deal with China, or some kind of deal, or delay to tariffs. So the 30-year, I think, will be on everyone's mind this week. And I heard the U.S. Treasury Secretary talk about this, and he has been quoted as saying scary. So I haven't even got to put the words in your mouth, right? Yeah. So I think he's not wrong.
Not your words, to your point. Well, does the downgrade matter?
Well, it's a catch-up. It's not like 2011.
Where we had the first one,
it just completes the set. The thing is, what else do you buy? Now, in the preamble to the show, we were just chatting. Look, you've got the best part of $30 trillion of marketable securities in U.S. Treasuries. It's 29, but going on 30. And I don't really see any other market that offers that kind of liquidity. But what you can do is think about a basket of alternatives. Now, what's happening here with the softening dollar should be good for emerging markets, the local rate markets. It should be good for bonds in Asia, for example. The issue here is that there isn't the yield. And look at the yield on China government bonds, for example. It's so far below the US equivalent. So we have to look at bonds versus swaps and yield curve shapes to get the value. On an outright basis, you have to go to countries like the UK to get additional yield over treasuries, for example. But you could build a basket of European, Asian, and Asian bonds, maybe some LATAM as well, to start to get a yield that's above the treasuries as an alternative.
That's the tactical substitution that you've been outlining there as well. So on an outright basis, if you could specify then, what are the plays on outright? And if it's Asia EM, is that swaps? I'm hearing that correctly?
Look, I don't think US yields can go up that much from here.
Long end.
No, I think that we're going to flirt with this 5% level for the 30-year. But the 10-year is still comfortably below the high for the year. I think that the cooling economy should be consistent with lower yields, and then swaps are the better way to play the direction of lower policy rates in Asia. That's something we've highlighted recently.
Right. And in Europe, what the play there is it relative between what you see in the UK and
the UK is the best of the bunch, really. The yield is actually above treasuries, and I think that you don't have questions about independent central banks in Europe, for example. Now, part of the cheapening of the US Treasury market is down to the narrative around who's the next Fed chair. Is the central bank independent? What are they going to do if what? So there's fiscal, central bank independence. You don't really have the same set of concerns in Europe because you've got independent central banks and you've got some fiscal constraint. And in fact, it's a bit of a paradox, really. Countries like the UK have gone through these shocks on the fiscal side, and that limits what they can do now. The US seems to be flirting with that kind of narrative right now.
Right. Okay. So it seems, as the play now, is it sovereigns and rates? And do I need to be anywhere near credit at the moment?
At least the investment grade credit has had a bit of a correction. We're mildly bearish on the high yield, and I think that that's consistent with the slowing economy and expectations of rising default. But investment grade has at least corrected. It's very difficult to be short credit because of the carry and the roll.
Right.
That's the problem. So our preference is to sit in the belly, and we tend to look at sector preferences in credit. So we've favoured banks, for example, recently, and I think some of the more cyclical areas are more vulnerable in the second half of the year. But with credit, you have to be really patient, and it's difficult to be short credit duration.
Right. Now, the play in China is what, on the CGB curve?
Well, the long end is very steep, and this must be one of those consensus trades that people keep getting wrong, in that people try and equate bond supply in China, so increased issuance from government and local government, with a steeper curve. Okay. It doesn't seem to happen.
Yeah, why is that a mistake?
Well, it's because the bond yield ultimately reflects the longer run equilibrium policy rate. And that's proven just about everywhere. I know there's this narrative out there, there's more bonds coming, so the yield should go up. Yeah. That's not actually how it works. If there's more bonds coming because the fiscal policy is loose and the central bank revises the equilibrium rate higher, then yes, yield should be higher. And in China, that doesn't seem to be the case. I don't think we could argue that the equilibrium, longer run equilibrium, is going higher. It's been slowly going down through the last decade. So we think that there's an opportunity here to go against some of these steepening moves in the longer end of the China curve.
Okay, so that's a flattening bet right there. Final question for you: what do we avoid? What looks like a mistake?
Well,
anything.
It's always very difficult to find what the big risk trade is until afterwards, isn't it?
Yeah.
But I do think being diversified makes a lot of sense here. This isn't a cop-out, David. In all seriousness, who would have predicted the swings we've had in markets this year? Think about how the consensus was coming into 2025. In fact, we've seen many of the consensus trades completely get reversed. So again, it's having a spread, and in bonds, I think that the opportunity now to make these tactical substitutions out of treasuries into other markets. You can't sell the whole lot; the market is just too big. Right. But you can make these 1% incremental adjustments. You just think how much money 1% of the treasury market is. Right? When you've got $30 trillion, you're talking about significant potential flows. So you're just looking at those opportunities to switch into some of the EM local rate markets and into the developed markets in Europe.
And ironically, I think the cause for concern around treasuries is because of how big it is. And now I think finding an alternative is difficult because of how big it is. Yeah. Ironically enough. Stephen Major, fantastic. Thank you so much. I'm out of HSBC, Global Head of Fixed Income Research there. Just in time for the renminbi midpoint of the day, 719.16 against the US dollar, 2% either side of that, of course, is the onshore playground. 720.88 is the estimate there. In about 14 minutes from now, we'll be getting, of course, the April home prices. In about 45, the April data dump is also coming through as well. Stay tuned for that. Futures are pointing slightly to the downside. We'll talk more about that in a moment. Plus, of course, some exclusive conversations around the EV space, exclusive ones with Zhejiang Leap Motor and Yihang joining us from the BNP Paribas Global EV and Mobility Conference. But ahead of that, we'll be live, of course, out of Taipei for Asia's biggest electronics conference. Computex and NVIDIA CEO Jensen Huang is set to deliver a keynote speech over the next few hours or so. A preview of that, and of course the opening bell, 13 minutes away. You're watching The China Show. Good morning. Exhausted investors digesting the latest tariff talk out of Washington.
Prepare.
Good morning and welcome back. You're watching The China Show. You have geopolitics, and President Trump's tariffs are expected to be top of mind as Asia's biggest electronics conference. That's Computex, kicking off, of course, today. In Taiwan, the ongoing tensions, of course, are seen as upending the way that the world's most prominent tech firms, such as NVIDIA, for example, have traditionally done their business. Annabelle Jewelers, of course, is with us live from the conference in Taipei. Morning, Belle, and I hear it's slightly buzzing already. What's in the agenda today?
Yeah, I can tell you, just to set the scene here, it's very hot. I think that the temperature is supposed to be feeling around nearly 40 degrees today in the sun, 37 in the shade. So it's very, very hot here today. But also hot, of course, is this event. And we've got crowds that are starting to come in behind me, you can see here. So this is setting up for Jensen Huang's keynote. This event is at absolutely maximum capacity here, so there's going to be thousands of attendees that are coming to hear what Jensen Huang has to say about the future of AI, we can expect, also about their cutting-edge hardware as well, and how they see that continuing to play out. So some product announcements could be on the way. So that's really the focus of this event today. Broadly, though, this event really comes in the shadow, of course, of these rising tensions between the US and China. There's question marks. Yes, we're continuing to see that spend on AI infrastructure, but do we need less of it moving forward? So still that deep-seat question continuing to play out as well.
Yeah, and Belle, you managed to catch up with Jensen Huang ahead of the event today, and I think first part of the question is what did he have to say, and also I would imagine what's next after these the chip restrictions around, of course, their chip to China.
Yeah, we can kick off with that first part because Jensen Huang, he was already been here for a few days, so we're really following his movements around the city over the weekend. But Jensen Huang is here in Taiwan just very shortly after that trip to the Middle East, where there were these multi-billion-dollar deals that were signed to send chips and AI accelerators to the UAE and also to Saudi Arabia. Now, the question is, when you've got so much technology that's leaving the US, going into the Middle East, does that also raise the risk possibly of diversion and for chips making their way into China? I asked Jensen Huang about that. Here's what he told me.
Governments understand that diversion is not allowed, and there's no evidence of any AI chip diversion. Now, recognize our data center GPUs are massive. These are massive systems. The Grace Blackwell system is nearly 2 tons, and so you're not going to be putting that in your pocket or your backpack anytime soon. And so these systems are fairly easy to keep track of. But the important thing is that the countries and the companies that we sell to recognize that diversion is not allowed, and everybody would like to continue to buy NVIDIA technology, and so they're very well. They monitor themselves very carefully, and they're quite careful about that.
So really downplaying any concerns around diversion to China of that technology. I also actually asked Jensen Huang what would be next. What's the next chip for China after the H20 was banned for exports there just a couple of weeks ago? He said that they're still working on that. He said it's not going to come from the Hopper series because that can't be modified any further. But NVIDIA as a company really risks losing ground to Huawei as well in mainland China, given that it can't sell its more advanced technology. Now, I asked him about that as well. He said it is a real challenge for the company, but they're just going to continue to do their best there.
Rockstar coverage from Bell and the team there in the extremely hot and humid Taipei. And, of course, more coming through as well with the big speech coming through in the next few hours or so. Going into the open today, it's the opposite of hot and humid. Well, it is hot and humid. Markets are the opposite. 0.8% declines going into the pre-markets today here in Hong Kong. Plenty more ahead. Right. The story across these markets is pressure on risk assets, including U.S. Treasuries, including specifically the long end of the curve here. As you can see, we're looking at the down day going into the open here today. Under pressure still. The dollar's down against virtually all of its peers, certainly against most of its G10 peers as we speak. Your pre-markets, Hang Seng Tech, and some changes, by the way, to those benchmarks, which I'll tell you in a moment there. But as you can see, we're looking at a down day ahead of some key data coming through. And changes from 83, we go to 85 members on the Hang Seng Index. The top two on your screens are additions to that. BYD is being added to HS Tech, and China Litz is being taken off. So, yeah, that and the open are just ahead.
As I reach a milestone in my life, I'm humbled by my good fortune, yet well aware that I still have much to learn. And if I stay true to myself and follow my instincts, my legacy will be looked on kindly by my friends, my family, and hopefully generations to come.
Good morning to all our viewers joining us from across the Asia Pacific. Thanks for joining us and taking the time. Hope you all had a good and restful, and I guess in most cases, looking at the Asia Pacific, I guess a hot and humid weekend, looking at where the temperatures are going. Out of the United States, thank you for joining us and good evening to you, and certainly the story coming.
नेचुरल गैस बुल्स का इंटरेस्ट मिसिंग हो गया, अभी भी है सपोर्ट पर ही, देखते हैं क्या होता है. ठीक है, दो ट्रेड है, ध्यान रखना, ज़्यादा बड़ी क्वांटिटी लेना मत. नेचुरल गैस में साइडवेज गया तो कुछ मिलेगा नहीं. बाकी हम मिलेंगे अब कल. थैंक यू सो मच फॉर ज्वाइनिंग टुडे सेशन. सी यू टुमारो. बाकी क्रूड ऑयल में ध्यान रखना, ये पहला टारगेट इस रेंज पे रख सकते हो. इसके नीचे सस्टेन करेगा तभी दूसरे टारगेट पे जाना, डायरेक्टली दूसरा टारगेट नहीं है. ठीक है, फर्स्ट टारगेट दिस वन, इसके नीचे सस्टेन करता है तो सेकंड टारगेट. बाकी नेचुरल गैस का लगा ही रखा है, देखते हैं आता है मोमेंटम या साइडवे चला जाता है. ओके क्रूड ऑयल आ गया है, देखो टारगेट तक। पहला टारगेट हो चुका है क्रूड ऑयल का, बुक कर सकते हैं, ठीक है। बुक द हाफ प्रॉफिट इन क्रूड ऑयल एंड ट्रेल द रिमेनिंग क्वांटिटी। अगर ये क्लोजिंग आ जाती है इसकी 5310 के नीचे, 5310 के नीचे अगर क्लोजिंग आ गई तभी ये सेकंड टारगेट देगा, ठीक है। अगर क्लोजिंग नहीं आती इसके नीचे तो फिर ये सेकंड टारगेट नहीं देगा, तो इतने में हाफ प्रॉफिट बुक कर लो, लगभग 50 पॉइंट का टारगेट है। देखते हैं क्लोजिंग आती है नहीं आती, अगर ट्रेलिंग एसएल जाएगा तो निकल जाना। टारगेट डन इन क्रूड ऑयल, ठीक है। टारगेट हो चुका है क्रूड ऑयल का। क्रूड ऑयल में बुक कर सकते हैं, ठीक है। सेलिंग का बुक कर सकते हैं।
That their application for a listing is now being reviewed by the exchanges. Foshan Haitian listed onshore. No other details so far, but again, it just underscores the extremely busy year we've had for listings here. And of course, in terms of earnings coming through, you have Baba, Zhejiang Leap Motor, and also CLP are set to report.